Wild swings. Chinese state-backed funds intervene amid an equity rout. The CSI slumps again after clawing back ground midway through the morning. And Standard Life Aberdeen slashes its dividend. The CEO, Stephen Bird, tells us that his business is positioned for growth this year. Good morning, everybody. It's just coming up to 7 o'clock then here in London, which means just coming up to 8, sorry. Nearly made you repeat an hour. Just coming up to 8 o'clock here in London, which means we are just seconds away, 15 seconds away from the start of the European equity trading session. Futures are pointing to the downside, apart from in Paris, where we see futures pointing a little bit higher. We heard from Danny Berger about some of the stock-specific stories that could help move these markets around. A bit of M&A, a bit of brighter corporate reporting from some around the advertising sector. We wonder what kind of benefits that might bring. But broadly, in the US yesterday, we saw the Dow, the Nasdaq, and the S&P all losing ground towards the end of the session, which means at least at the start of the European session today, we have a bit of catch-up to play. We have to price in some of those losses, it would seem. And so we see the London market moving to the downside, down 0.25%. The IBEX down 0.1% as well. So we do see a little bit of weakness coming through at the start of the European equity trading session. But those US futures do still and persistently have pointed to the upside. Nasdaq futures up by 1.5%. S&P futures, E-mini futures up by 0.7%. So we keep that in mind as we go through the early part of today's session. In terms of the Asian session, of course, we saw a great deal of focus on what was happening in the Chinese markets, and the Shanghai Composite down by 1.8% by the close, the Chinex down by 3.5%. So there was some hefty selling there, despite some action from the state-related funds. So that's certainly something we should keep an eye on as well. A big rotation in markets, that's obviously part of the story. We'll see how much of that is coming through here in Europe. So European equity markets opening then broadly to the downside, and US stock futures climbing after an overnight slump in tech stocks amid a rotation to value. Joining us now is Paul Brain, Newton Investment Management Head of Fixed Income. Paul, good morning to you. Good to speak to you. And I suppose from a fixed income perspective, we take this opportunity then to think about just how high yields can go from here, because that is what is in large part behind this rotation we're seeing in stocks this morning and many other mornings at the moment. So Paul, what is the limit? What's the maximum that you see the 10-year yield getting to?
Yeah, good morning, and thanks for having me on. I've been asked this question nearly every day for the last 3 weeks now. It's quite funny. Essentially, of course, markets are worried about how high Treasury yields could go because, of course, there's a lot of pent-up speculation in a lot of other asset classes. Of course, you know, the equity market, but also high-yield emerging markets, emerging market debt. The easy answer is that yields are headed higher because, of course, we're looking at stronger growth. We're looking at the potential for higher inflation, and we've come from a very low base of yields, so yields do need to go higher. They are going to be controlled on the way out because most of the buying is coming from central banks. Most of the buying is also coming from the banking sector. But most real money like ourselves is probably underweight its duration benchmark and is happy to see rising yields. And then in some cases, traders are going to be short. We've got a lot of supply to get through. We've got supply this week. We had obviously a scare about the 7-year auction a couple of weeks ago. That supply is going to take time to be absorbed, and there isn't the demand because of that real money demand that isn't there anymore. So I think, you know, we're looking at higher yields. How high? I think we have to pause every now and then. It seems we've got up to a level fairly quickly that seems to spook other markets, and I think we should be pausing around this sort of level. And this particular auction this week will test that. Beyond that, we're looking at 2 to 2.5% being sort of the midpoint this year. So through the middle of this year, we could be at 2.5% yields.
Okay, 2 to 2.5%. We're at 1.54 this morning. So those yields coming down actually a little bit in the most recent market moves. And we see NASDAQ expectations there. The futures point to the upside, and that sector rotation maybe just on pause here in Europe. But when we think about the auctions that are still to come, Paul, they really did rock markets, didn't they, over the last couple of weeks or so? Do you think we see a repeat of that? Do we see a repeat of a situation where investors are not willing to come in and pick up that pick up what is on offer at those auctions at the yields that are available? Are we going to rerun that conversation? Because that is something that seemed to quite quickly spook investors.
Yeah, I think that is definitely possible. Of course, we're never too certain about the appetite of the market at any given time. And because the 7-year was such a shock in terms of its lack of demand and the spike in yields, it's likely that investors and traders are in a better position this time around to absorb this 3, 10 and 30-year auction. The 3, 10 and 30-year auction usually is the best one to set the scene for potential demand going forwards. The 3-year tends to get absorbed fairly well, but it's the 10 and the 30-year auctions as a real test of the demand for longer dated securities. I think the 7-year was a shock. We came in a period when we had a lot of indigestion in bond markets. There's been a lot of supply from obviously the government, but also from corporates at that point. So there was probably a serious case of indigestion. It's less of a case this time around because of that shock that we saw. And I'm expecting the auctions to be okay. But the 30-year one is the one that's going to be the real test. If that fails, then I think we'll be looking at those higher yields at a much faster pace than we're looking for.
Okay, so we'll certainly watch the 30-year, watch the long-end auctions. What kind of yields do you think the US economy, Paul, can withstand right now? I was looking at some details on the American housing market yesterday. 8.2 million Americans behind on their mortgage payments. When forbearance comes to an end and we start to see foreclosures coming in and that kind of hit to the US economy, is that the kind of thing, some of that underlying economic fragility, if you like, is that what's going to put a lid on some of these yields?
Absolutely. That's the thing that contains things. That's the thing that stops yields getting out of control, is just that underlying softness of the economy, the high unemployment rate, the potential for investors, for homeowners to fail to pay their mortgages and interest rate payments. And then, of course, it's the underlying corporate economy. The companies have borrowed an awful lot at very low interest rates. That's not a problem for this year, perhaps. It could be a problem as it builds over the next couple of years as they look to refinance that. So essentially, I think it's that high level of debt in the economy, both at the population level as well as the corporate level, that does keep the lid on yields. Of course, in the short term, it's the market response that is probably more worrying. The response that we're seeing in the equity markets and potentially in markets like high yield, that response is more fragile. Those markets are more fragile to higher interest rates, perhaps, than they have been in the past. The economy itself, outside of the concerns about debt levels, we are looking at, of course, a potential for a rather significant economic recovery being fueled by, of course, fiscal stimulus as well as very loose monetary policy. So unless cash rates rise very sharply, which we don't believe, and unless that fiscal stimulus is reversed, we're looking at stronger growth, which means that we could survive slightly higher bond yields for the time being.
Paul, thank you very much. Paul Brain, Newton Investment Management, Head of Fixed Income. Paul stays with us on the programme. We'll get further thoughts from him shortly. Also coming up here on the European Market Open, we take a look at some of the biggest stock movers, including ITV, slumping this morning as advertising revenue, or despite the fact they talk about advertising revenue rebounding. What's happening? The stock's down by more than 4.5%. This is Bloomberg.
80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
We're in the beginning of 2021. What are your biggest worries?
The inequality of the current world environment. It's troubling, and I think it's actually getting worse, which is a big challenge.
Welcome back to the European Market Open. 10 minutes into a European session that is negative, not by much though, down by just 1/8% or so on the FTSE 100. The DAX coming in down around 0.3%. Let's take a look at some of the stocks that are on the move. Bloomberg's Danny Berger is here with some of the details. Danny.
And really what's dragging some of these indexes down are material stocks, one of the biggest movers to the downside. We're looking at some of these iron ore, different metals moving lower today, perhaps some of that commodity super cycle giving up steam. So stocks like BHP, some of the biggest droppers. But the biggest dropper that we're seeing on the Stock 600 ITV, it's that advertising revenue question that's really lingering. Yes, they did better in the fourth quarter, but for the first quarter, they see a drop of about 6%. Also saying that they can't really give an outlook or a dividend forecast given the uncertainty. Finally, Pandora, the Danish jeweler, they are seeing shares rise today of more than 6%. They say that now 25% of stores were open at the end of Feb. That's better from 30% at the start of the month. Also very confident in their 2021 outlook, holding it strong, saying they saw 12% organic growth in the quarter. Now, a quick look at the macro picture. I want to show us where we ended up in China, because that was a pretty weak session. You can see behind me, despite the state intervention, still people in the U.S. happy to go in and buy the dip. We're looking at NASDAQ futures up more than 1.5%. That probably has to do with yields easing somewhat as well. We're seeing them below 1.6% after the big jump we've seen over the past few days. Of course, this still remains front and center in terms of investor concerns, Anna.
Yeah, absolutely. Despite what's happening today with yields a little bit lower, still very much at the forefront. Danny, thanks very much. Danny Berger with your movers this morning. Now, the Bloomberg Dollar Spot Index reached its highest level since November during Monday's session. The greenback is up almost 3% this year, buoyed by the rise in U.S. yields and improving trends in the American economy. But will those trends continue? Paul Brain, Newton Investment Management Head of Fixed Income, is still with us. And away from the fixed income space, Paul, I know you obviously give some thoughts where you think the dollar is heading. 2021 has been pretty good for the dollar, but it's been a different reason, a different narrative to why we saw the earlier part of 2020 being positive. I wonder where you expect it to go now. We see dollar weakness returning to the markets this morning.
Well, essentially, the story for dollar weakness is still there. It's much that you've got the potential for the current account to be stay high. You've got the Fed sitting on very low interest rates for a long period, and you've got fairly strong growth around the rest of the world. But of course, at the moment, the US is leading that growth story, and with the fiscal stimulus coming through as well, it's likely that the US will be seen to be the potential, or the area for potential growth going forward over the next 3 to 6 months. And the rest of the world then plays catch-up. It is interesting that we've got dollar strength as well as, of course, we've got some commodity price increases as well still coming through, and that's obviously a follow-on from last year. I think it's going to be a much more mixed story with currencies this year. We prefer growth currencies, as those currencies that are linked to that economic growth story, emerging market currencies, some that are linked to, of course, commodity prices as well. And we're funding those currency purchases from some dollar shorts, but also a mixture of low interest rate currencies like the euro and sterling, and also potentially the yen going forward as well.
Okay, so does that mean that you're not so concerned about emerging market debt and what any dollar strength might do to that, Paul, given what you've said there about your assumptions on the dollar? I mean, that has been a concern, hasn't it, for those with exposure to emerging market debt, what we've seen in the FX markets of late?
Yeah, you can't dismiss that, because, of course, that is a worry. They have borrowed a lot. They need to continue to borrow, and we are seeing rising yields there. And the underlying base, which is, of course, the US Treasury market, is also, as we've seen, shifting upwards. We're coming from a fairly low base. I mean, the interest rate cost for emerging markets is fairly low, and that economic push that we expect to see coming through, especially in the second half of the year, means that their revenue is going to pick up. So in the short term, yes, we're concerned. I think longer term, we think that those currencies and those markets can do better. And a lot of them, of course, have been able to divorce themselves from the US interest rate story. They've been funding themselves in their own domestic market and have a slightly different interest rate path. And it's those markets we prefer rather than the ones that are perhaps more dollar-centric, which are, the Latin American countries in particular are going to struggle. But we prefer Asia, where we see a different interest rate path and a different currency path.
Okay, Paul, thanks very much for your time. We really appreciate your time with us this morning. Paul Brain, Newton Investment Management, Head of Fixed Income. Paul will be continuing his conversation with us on Bloomberg Radio. That is at 9 a.m. UK time. Coming up on the programme, 14%. That is the average gender pay gap across the EU. We speak to the European Equality Commissioner about the bloc's plans to narrow the gap and ultimately to close it. That conversation next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
The labor force rate for women now is much lower than for men.
You need workplaces that are truly inclusive, that break down the barriers that keep women and people of color and LGBTQ disabled workers from not only coming into the workforce, but staying in the workforce.
Female business leaders are actually saying that household chores are impacting their work.
I think some of the things that are being contemplated as well in terms of the minimum wage and increasing the minimum wage to allow women to be able to afford childcare is critically important as well.
I would argue, and it's a frustrating argument to make, that women are dropping off even before the stage in which they're having babies.
We make up a disproportionate share of those low wage paying service sector areas of the economy. So of course, if I put it in the context of COVID, we were hit tremendously harder.
A number of prominent newsmakers on Bloomberg TV speaking about retaining female talents in the workforce. It was, of course, International Women's Day yesterday. Let's continue the conversation, though, about pay equality, specifically in the EU. The average gender pay gap in the bloc sees women paid 14.1% less than men. The European Commission has unveiled draft rules to help close this gap by mandating greater pay transparency. Companies that don't provide information on how they pay women and men differently could face fines for non-compliance. For more of this conversation, Maria Tadeo, our reporter in Brussels, joins us with a really interesting voice on this story. Maria.
Yes, Anna, it's 14% less that women get paid on average in the European Union. You're looking also at a 30% less, smaller pension when you retire, which is also a source of financial stress at times. And to talk about this, we're joined by the European Commissioner for Equality for the European Union. That is Elena Dalli. And Commissioner, you know, it's been International Women's Day yesterday. We've talked about the pandemic and the impact that it has on women. And then, of course, we have that figure of 14% less for doing the same job. So I wonder, in 2021, how do companies get away with this?
Well, actually, it's been enshrined in the treaties since 1957, the concept of equal pay for equal work and work for equal value. But something is wrong, obviously, because otherwise we wouldn't have that gender pay gap and that pensions gap. So one step in the direction of amending this reality is to have pay transparency. So now employees can demand from their employers transparency if this proposal for a directive goes through. But as I said, it's only one part of solving this problem, because this is a very complex problem, and we know also that women lose on the way in their career trajectory because of work-life balance, for instance, and still women do disproportionately a larger amount of the care work for children, for little children, for instance, and home responsibilities. And in the end of their career, they find that they have worked less and contributed less in terms of their contributions, and therefore this will affect also their pensions. So it's a complex problem, and we are addressing it, and this is one part of addressing the problem.
And Commissioner, the way that this would work is, if I understand it correctly, you as an employee can go to your employer and ask to see payments or salaries based on female, male gender. But, you know, I do wonder, critics say that the problem with this is that it really depends on companies and their goodwill and whether or not they want to be transparent. Shouldn't you be more aggressive, perhaps, on those companies, naming and shaming them?
Well, this is a directive. If it goes through, it will be a directive, and there will be sanctions. But I must say that during the preparation for this proposal for a directive, we had obviously social dialogue. We had conversations and with social partners, with unions, with employers, and we could see that the employers who already have this kind of transparency are doing very well, and their employees have the peace of mind that they are being treated fairly and equally. So I think that employers will see that it is to their advantage that they give their employees this kind of peace of mind, and they are happier at the place of work. But of course, there will be employers who will not like this, and that is why we felt that there is this need for a directive, and therefore now they will, once the directive passes, they will have to give this information. And as you know, the reporting is on companies which employ over 250 people, but the asking for information is every worker's right, and it is every employer's obligation to give that information, even if you are just employing 5 or 10 people.
Right, and although the criticism, though, at that point is that you as a worker would have less leverage than the person that employs you purely because of a relationship of power there. But I do wonder, when you look at fines, I know you mentioned that. Is that something that you see almost as a nuclear option, or is it something that you're now willing to put on the table and fine a company for not paying equally?
Well, then this fining business is up to the member state, but we will give direction, of course, on this. But I would rather that more employers will see and understand that this is a good thing. We are working towards a union of equality. You cannot have a union of equality when you know that women are working for free for a part of the year, because this is what it amounts to. This is not equality. We want to encourage more women to enter the labor market. We have seen the disproportionate effect of the pandemic on women. We need their talents. We are wasting talent, and especially when we see that there are so many women in education and training and graduating from our universities, and then you lose them. So they're off the radar for years sometimes. And all this is very discouraging when you see that you are not being treated equally as your male counterpart. So there is more to it, even the discourse, the public discourse, the fact that we are talking about it, that we are addressing it, and I'm sure that employers are realizing that this is.
Right, and just Commissioner, very briefly, because we're running out of time, what do you do with countries like Poland? I mean, we're talking about equality here, but we know that rights for gay people have been stripped away. We know that rights for women, abortion, and so on is becoming complicated. They do profit from being in the European Union. Isn't there an element of just something that's not right?
Well, as you know, that the European Union, the Commission, is doing a lot in terms of LGBTIQ rights, and also in terms of women's rights. We've just had last year the gender equality strategy and the first ever LGBTIQ strategy, which shows member states the direction that the European Union wants to take in these areas of policy. But there are certain areas also which are not the competence of the EU. So we speak about the right of every person and in terms of sexual and reproductive health and rights.
Yes, and that's a very important conversation. Unfortunately, we're running out of time. Thank you so much for joining us on Bloomberg here and Bloomberg Television. Thanks for your time.
will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. 30 minutes into your European trading session. Things looking a little bit more mixed than they did. We're fairly flat, actually, on the Stock 600, on the FTSE 100. Would be pretty rare, given the size of the moves to the upside yesterday in Europe, to see today's session. I'm told by our colleagues on the Markets Live blog, to see today's session to go higher. But we do have US futures pointing higher, so we'll see how we pivot as we go through this morning's session. And here's the breakdown in terms of the sectors. It is an interesting one, away from the pivot out of tech and into value, and that's the conversation globally, of course. But here in Europe, that sometimes lands slightly difficultly, and today is no exception to that. We have energy moving to the upside, up by 1.4%, but basic resources down by 1.7%. So at either ends of the spectrum today. So that's a look at where we are on the sector picture. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. The future of Hong Kong's electoral system remains in focus at China's annual National People's Congress. Critics are concerned the changes will just tighten Beijing's grip on the financial hub. Asked what kind of criticism will be allowed after the new legislation, the city's top legal official is warning residents not to stray too far from the facts.
Criticisms that are fair and rational and fact-based would, of course, be well taken, because in a democratic society, one needs to take those on board and then analyze it in order to formulate the policy.
U.S. airlines are urging the Biden administration to take the lead in developing a temporary virus passport to help reopen global travel. Industry leaders say the White House has to act quickly to develop these standards to support the industry. It comes amid a significant slowing of infections in the U.S. despite an uptick globally. A Swiss pharma company will begin producing the Sputnik COVID-19 vaccine in Italy, the first European production of the Russian shot. No targets are being set, and production is subject to approval from Italian regulators. It comes as Prime Minister Mario Draghi is vowing to speed up Italy's vaccination drive. 100,000 Italians have now died from coronavirus. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Back to the markets now. The tech sell-off in the US has sent ARK Investment Management's main ETF to its worst loss in a year. It's now wiped 30% from the company's flagship investing strategy after last month's high. Founder and CEO Cathie Wood says she's keeping her eye on the prize, sticking to her highest conviction names, including Tesla.
When we go through a route like this, first of all, the rotation now is happening very quickly. It started off slowly and is happening quickly. So I'm happy that the market is broadening out. This was the case in late 16 as well. Value took off and left growth behind. And whenever I see that happen, I say, okay, this bull market has broadened out. This is good news. What we do during these periods is concentrate our portfolios towards our highest conviction names. And so that's what we're doing. We had extended the number of names in the portfolio from the low to mid 30s at the bottom of the coronavirus. And now we're at roughly 55 for our flagship fund. And we are starting to sell the more liquid names and buy some of the more pure play names. So the more liquid names are either more mature, the Facebooks, the Apples, and so forth, or they are participating in innovation, but they're not pure plays. So Regeneron, Novartis, and so forth. So more liquid in order to have cash-like instruments to use at a time like now and move, again, concentrate towards our highest conviction names.
So let's talk about Tesla then. You said that you were only going to buy the dip. Are you going to continue to buy the Tesla dip now that it's dipping even lower?
Yes, we can buy a stock up to 10% of our portfolios. And that's certainly in the ETFs. We report our holdings at the end of every day, so anyone can see that. And yes, we have been building whenever we can. Now, we built up to 10% last week, so the stock behaved in line with our portfolio. So again, we can't buy anymore here. If it were to deteriorate at a rate beyond that of our other portfolios, so drop below that 10%, we would then have the latitude to buy more, of course.
Now, you've said you're going to put out a new Tesla price target. The market is anxiously waiting for that. When are we going to see that? Can you give us an idea of what the target will be?
Well, it's going to be I'm going to say a couple of weeks. We're getting compliance is helping us cross our T's, dot our I's, and do everything we should do before we send it out. But the two things that have happened to Tesla since our last projections are, one, it has increased its market share. When we put out our original $4,000 price target, so the equivalent of $800 now, we thought that Tesla's share would drop from 17%, this is share of the electric vehicle market, global electric vehicle market, from 17% then to 11%. Instead, its share increased as others with wonderful brand names started increasing the number of electric vehicles in their companies. So that was a big wake up. In the United States, I think Tesla, through the third quarter at least, was still 80% of all electric vehicles sold in the United States. So pretty stunning. The second thing that has happened is autonomous. The probability that Tesla gets autonomous right, we believe has increased from the 30% that we had in our base case in our last model. What's interesting about autonomous is the margins in autonomous, the gross margins, are in the 80% range. The margins for electric vehicles alone are in the 25 to 30% range. This is a 5-year projection. So the model changes completely if Tesla gets autonomous right, and we think it will.
That was the ARK Investment Management founder and CEO Kathy Wood talking about Tesla there at the end of that conversation. $563 a share is where it trades right now. Just looking at the EE function on the Tesla page on the Bloomberg tells me the top estimate or the top target at the moment is $1,200 to $1,200. We'll see where ARK comes in relation to that. Now, as Kathy Wood navigates the sell-off in her growth-heavy funds, a different kind of investor is enjoying a record run. Value investors. It's the latest turn in a market coping with higher yields and the prospect of a cyclical upturn. Joining us now to look through the data, Bloomberg's Danny Berger. Danny, why is now then the right time for turning to value? As I was discussing many times with Mark in the first hour of the program, we have had these conversations before, but this does seem to have, more legs?
Yeah, well, I think when you see this violent upturn in yields, it gives you a picture where you focus really on the near term or at least medium term realism versus that long term outlook. And of course, these growth stocks, it's all about future cash flow. And that future cash flow is going to be discounted in a world where yields are moving higher, not to mention they can start to compete with dividends. So that's how we see some of the extreme market moves we've seen over the past week or so. Now, here is pure value versus growth on a weekly basis. And this is pretty remarkable that last week we saw value outperform the most on record. So that means it beats out the quant quake of 07 when we saw quant factors act strange heading into the financial crisis and back at the end in the aftermath of the dot-com boom. Of course, it's a really violent rotation. It happened quickly. So you get this picture. Okay, is this just a one-off? Does it continue to happen? Well, Anna, investors are putting their money that it will continue. If you use ETF flows for a proxy, on a quarterly basis, we're about to head near $20 billion flowing into the U.S. factor. If you add Europe, you of course get more here. And that will be a quarterly record of inflows into this type of factor, which I should say has been very unloved. So you are starting to see more conviction heading into these cheap stocks.
Yeah, interesting use of those factors then in the analysis, Danny. But how long does this last for? Does this all come back to how long do we see Treasury yields rising? And we see such different views on that every day.
Yeah, Treasury yields rising, of course, is a really important factor. It also feels weird of talking about the longevity of this on a day when NASDAQ futures are up more than 1%. So there's already a little bit of wobble in this trade. But John Authers points this out in one of his recent pieces, citing Cliff Asness of AQR. And if you look in the past when we saw valuations get really extreme, so this is Russell value compared to the wider benchmark, looking at its price to equity ratio, when it gets really extreme, that's when we get this sustained outperformance. And look, we are near that now. This is a pretty extreme valuation gap. So it would stand to say that if history repeats itself, we could see value start to outperform. At least some of the setup is certainly there, Anna.
Yeah, certainly the conversation of the month, it seems, Danny. Thanks very much, Danny Berger, with the latest on that rotation we're seeing in stocks. Coming up on the program is Thursday, the new Friday. We speak to a company that's giving its workers a 4-day week without changing their pay or seeing a drop in productivity. We discuss that next. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the European market open. 43 minutes into our trading session, and things looking better than they did at the start. If you're long of these markets, Euro Stoxx 600 is flat right now. The FTSE 100 up around 1/8% or so. A little bit of weakness elsewhere. US futures also pointing to the upside. NASDAQ futures up by 1.7%. We were just talking about that rotation out of growth into value with Danny. That's certainly been a theme of recent weeks, even if we see it being tested today. But bear in mind that bounce back in NASDAQ, in the NASDAQ Nasdaq that the US futures anticipate comes on the back of heavy selling yesterday. Now, a century after the invention of the weekend, more companies are adding another day. One of those companies giving employees Friday off is Berlin-based tech firm Awin. Last spring, they told everyone to sign off around lunchtime on Friday to ease into their weekends. The experiment was so successful that this year the company went a step further and rolled out a 3-day weekend without cuts to salaries or bonuses. But is this a trend that's here to stay? Let's talk to Adam Ross, Awin's CEO. And I know it's a bit more complicated than a long weekend, isn't it, Adam? Because you allow some choice as to which day or half days your staff take off. But what has been the impact? Give us some stats then on the impact in terms of productivity or what the business has been able to achieve even as shorter hours have been worked.
Yeah, I mean, we look at it across 3 separate dimensions. The first is the financial performance of the company, and we're very fortunate to have record performance. We grew the revenue that we generated for our clients by 39% last year, up to 15.5 billion euro generated. We also look at the engagement and the happiness of our staff. It's something that we've religiously monitored for years. We've seen big jumps in stats like their overall engagement, how likely they would be to recommend Awin as a place to work. We were voted one of the top 50 employers in the UK by Glassdoor. And on top of that, we also monitor our client satisfaction scores. We do this by NPS, a Net Promoter Score. It's a measure of how likely a client is to recommend Awin. And those scores are also significantly up. So we had a lot of evidence to support this trial. And now 2 months into it, all those stats are still looking very positive and moving in the right direction.
Adam, do you sense that there's a moving target here, or have you got this right? I just wonder, you know, if I had to work 7 days a week, I might want to work 6. If I work 6 days a week, maybe I want to work 5. If I work 5 days a week, maybe I'm happy initially with working 4, but then I come to you and say, actually, you know what, Adam, I'd quite like to work 3. Do you think you've got it right, the balance here between the working week and the time off?
I think time will tell. We're doing a 6-month trial, and the early results are extremely positive. And we had also the experience of the 6 months prior on a 4.5-day week. It seems to be working well for us. It needs to be very carefully monitored. But our fundamental belief is that happy, engaged employees that have a healthy work-life balance will produce more, will be more loyal to the company. You know, it's a huge benefit to the company and a great tool to aid retention and for hiring. We operate in some of the most competitive employment markets in the world. And so this is one of the critical tools in our arsenal. And it's also about being entirely outcome focused as an organization, right? So as long as everybody's working towards carefully constructed, regularly reviewed and measurable goals, we don't really care how, when, or where they work, as long as they're producing towards those. And this is just a move in that direction. And it's also about being an organization, an employer that's that treats their employees based on trust. Right? The relationship is fundamentally based on trust. And so many companies and so many policies that we see, they assume actually that the employee is trying to get one over on the employer or is trying to slack off. And I think if you flip that model around and you base that relationship on trust, it pays dividends.
Do you sense that this is something that works in some cultural contexts and maybe not in others, Adam? I mean, maybe it works today in London, today in Berlin, maybe not today in China or in 1960s Germany. How important is the cultural context in which you're running this experiment?
It's definitely important, and I think also, even company culture plays a big part in this. It's not going to work for every company or every company culture, but I think doing what we do, knowledge-based work, I think there's a very strong case for this, and our intention is to prove that.
Okay, Adam, really good to speak to you. Thanks very much for bringing us your experience. Interesting experiment, one that no doubt many of our viewers will be interested in. Adam Ross, the Awin CEO. Let's get a Bloomberg Business Flash, the top corporate stories we're covering this morning. Here's Laura Wright.
Thanks, Anna. Barclays is set to be planning job cuts at its corporate and investment bank as part of a wider cost-saving measure. Bloomberg sources say around 60 positions will go, including some senior roles in the US. COVID-19 has slammed the bank's lending business, and it sees that continuing this year. No comment from Barclays. UniCredit is cutting its 2020 bonus pool for top managers in half. It's complying with the results from regulators to exercise extreme moderation on compensation in the wake of the pandemic. The announcement underscores a trend of below-par payouts for bankers across the region. Deutsche Bank was also forced to scale back bonus plans after the ECB objected. Vodafone is looking to raise as much as 2.6 billion euros from a listing of its European mobile phone towers unit in Frankfurt, one of the region's biggest IPOs this year. The UK telecoms giant plans to sell shares at up to 29 euros apiece. Carriers are looking to squeeze value from their mast and fibre assets as they're hit by increasing competition and regulations. That's the Bloomberg Business Flash. Anna.
Thanks very much. Laura writes here in London. Coming up on the programme, is this a dollar revival or a false dawn? We can't answer it with one day's experience, but certainly the dollar on the retreat right now, the dollar down by 0.4% on the Bloomberg dollar index, but certainly the move has been upwards for the dollar in 2021. We'll put questions around the US currency to Laura Cooper, Bloomberg's Markets Live macro strategist. She joins us next. This is Bloomberg.
Everybody says we should practice before we go to Mars, but some people say we need to practice on the moon. Well, you could practice on the moon, but you can do it at 1/10,000th the cost in the desert in Utah.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. 52 minutes into a session that's actually increasingly positive for European equity markets. Stocks now in the green broadly across Europe, apart from Germany, where we're down by 0.2%. If we look at what's happening in US stocks, then US futures pointing to the upside, up by 1.6% on NASDAQ futures in particular. Let's get into a conversation then about these markets with Laura Cooper from our Markets Live blog. And Laura, it's interesting to see the dichotomy that we saw in the US yesterday with the NASDAQ under so much pressure and yet the Dow rallying. And then you think about the different trends we see stateside. Yes, we talk a lot about stock rotation, but it's complicated when you try and compare Europe with what's going on in the US.
Well, that certainly is the case. And I think what was quite interesting yesterday was actually something that a colleague of mine pointed out on the blog. And that's just the fact that the last time we saw the NASDAQ slip by more than 2% and the Dow gain more than 0.5% was actually the same day, March 8th, 20 years ago, so 2001, in the middle of that dot-com bubble. So it is quite exceptional what we saw in the US yesterday. Now, for Europe, slightly different story. We did see most European equity gauges really just performed quite strongly, their best days since November. And we tend not to see these bouts of, for example, value over growth sustained for a long period of time. So this could potentially be a head fake, but certainly the fact that we continue to see rising yields should support those energy, those financials that are concentrated in Europe. And we don't have that same tech exposure on this side of the Atlantic.
Yeah, it seems difficult to answer the question about how long this rotation lasts without a good understanding of how long we're in this conversation about higher yields on US 10-year or higher yields on treasuries more broadly, Laura. And I wonder what you're picking up on that front. Yesterday, I was reading that PIMCO says, we're set to trade in these ranges now. Inflation expectations have run too far, too fast. But certainly other guests talk about the upward moves that we could see in yields from here. What are you hearing?
Well, I certainly think that there is scope for yields to climb higher because, yes, break-evens may be fully pricing in inflation expectations. So when we look at the 5-year mark, they are pricing in just, the highest inflation that we've seen since 2008. But there is still quite a bit of scope for those real yields to climb in the U.S. because this is against a backdrop of just this improving economic outlook. And the Fed has made it quite clear that they are comfortable with yields rising so long as it continues to reflect upbeat growth and we don't see this tightening in financial conditions.
Yeah, and how comfortable will the Fed be with what this is doing to the dollar? Not today. Today looks different, but in general, the path has been higher for the dollar. And so on the Markets Live blog, you've been asking, is this a dollar revival or a false dawn? All of these questions linked because once again, this comes down to yields.
Well, and that's the case. I mean, certainly the dollar strength this year has defied consensus expectations for the greenback to decline. But when we look at what's happening in the yield environment, it's perhaps not that surprising. So when we look at the gap, for example, between the U.S. 10-year yield and German 10-year yields, they are the highest since they were back a year ago. And the dollar has kind of been dragged higher on account of that. So long as we see this ongoing divergence in yields with the Fed more comfortable with higher yields, whereas the ECB has made it quite vocal that they're going to step in should yields climb too far, I think we do have further room to see the dollar run. And then overlay that just with this still stretched positioning. So speculators are short the dollar. So there is the risk that we could see a short squeeze should the dollar continue to climb higher. So that does suggest that we could see the dollar continue to climb.
Laura, thank you so much for your time this morning. Laura Cooper, Bloomberg's Markets Live macro strategist. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets increasingly on the front foot as we head towards the US session, where the NASDAQ looks as if it could stage something of a rebound, but perhaps not making up for those losses of yesterday. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Happy that the market is broadening out. This was the case in late 16 as well. Value took off and left growth behind.
Like all of the manias, there will be choppiness, and I think you will see sharp corrections.
Fully vaccinated people can visit with other fully vaccinated people in small gatherings indoors without wearing masks or physical distancing.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance, the early edition on Tuesday, the 9th of March. I'm Francine Lacqua in London. Here's what's coming up on today's program. The great rotation, tech stocks take another hit overnight as the Nasdaq enters a correction. Is it time for value to shine? Eyes on the prize, Cathie Wood's ARK ETF suffers its worst losses in a year, but the cult fund manager tells Bloomberg she's doubling down on high-conviction names. More from our interview shortly. And there's tools for that. Janet Yellen plays down fears that President Biden's $1.9 billion stimulus could provoke runaway inflation. It's actually trillion, but the biggest yield GDP gap in over half a century suggests a bond sell-off has further to run. Well, let's get straight to the markets because there's quite a lot going on. Not even the government can stop Chinese stocks from selling off. The CSI 300 entered correction territory, prompting state buying of equities. But in a roller coaster session, sentiment soured again, and the index closed down more than 2%. Where Chinese stocks seemed headed in one direction, the story in Europe and the U.S., of course, is all about rotation. The Nasdaq fell 10% from its peak overnight, with higher yields weighing on expensive growth stocks. But as tech slip, strength emerges in other parts of the market. So let's get more on all of this with our Danny Berger. Danny, the real rotation, is this it, or is it just a false dawn for value's return?
I feel like so many times we're like, okay, value is coming back, and then as you say, it ends up being a false dawn. And I think it is really hard to tell in this circumstance, especially because the rotation has been so violent, so strong. Can it sustain? A lot of it has to do with higher yields. That changes the picture for discounting future cash flows, which gives you this picture. This is pure value versus growth on a weekly basis. Last week, we saw value outperform by the most on record, which is quite the feat. It means it beat out the 2007 quant quake that preceded the financial crisis. It also means it beat out the aftermath of the dot-com bubble. So based on that, it does seem like there are a lot of fans rushing into value. Value ETFs are also headed for their best quarterly inflow. But Francine, I want to take a look at today's U.S. markets and futures to give us a big chunky to be sure. That to be sure is that already today we are seeing people step in and buy the Nasdaq dip. Now, it hasn't made up for those losses we saw yesterday, but look, we're almost up 2% on the Nasdaq futures with yields moving slightly lower. So it is a very fragile picture. We have that big U.S. auction today, which of course is going to gauge some of the sentiment around that really big short we see on U.S. 10-year. But again, it could be a circumstance where any dip in those growth stocks are just bought and we don't get a sustained value rotation.
Thank you so much. Our Danny Berger there with the very latest on these markets on the move. Now, joining us to dig deeper into the markets is Eddie van der Walt, our MLive strategist. Eddie, a million questions, of course, about inflation, reflation. Are we going to see this rotation continue? What are the flashpoints that you're looking at?
Yeah, I think, you know what, I think, Danny,
Danny absolutely nailed it there. So the idea of the value rotation keeps coming back, and we every time we see a false dawn. The problem though is that looking at value as a factor, as some investors do, misses. I think the company specifics that a true value investor will look at, and I think that's what we're seeing here. We're not seeing a rotation away just from big tech to value as a factor. What we are seeing is really the return, I think, of the active investment strategies. And I think right now we're entering a stock pickers market where some companies are going to do spectacularly well because they're correctly positioned for this growth phase that we come out of. And other companies are really going to struggle because they've got old business models. And I think that is the moment in which we are right now.
Eddie, in an interview last night, Treasury Secretary Janet Yellen played down the chance that Biden's stimulus would actually cause inflation. Now, she says, I really don't think that's going to happen. But if it turns out to be inflationary, there are tools to deal with that. Is the market front-running this? I mean, is the market really looking at it for inflation, or are they just trying to test what we could have from Fed?
Look, I think the problem for Yellen and for other policymakers here is that if we don't see inflation, then asset prices have gone significantly ahead of where they need to be. So either we're going to see a significant correction in stock prices and, in markets broadly, which could, derail the recovery because because the stock market is a major input into how consumers feel about their spending, or we get inflation. And that's significantly bad for bonds, which then again weighs on equities. So I don't know. I mean, if I just objectively standing looking at this, I think it's a catch-22 that's really hard for risk assets going forward.
Eddie, thank you so much. Eddie van der Walt, there are Live strategist. Now, coming up, why ARK Investment Management founder and chief executive Cathie Wood is sticking with Tesla even after the tech sell-off wiped 30% off her flagship investment strategy. That's coming up next, and this is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's check in on the NASDAQ futures. This, of course, is part of the rotation story that we've been talking about over the last couple of weeks. Now, NASDAQ yesterday was actually quite significantly lower. Today, gaining some 1.8%. This is despite some of the movements that we're seeing in bond yields. Again, maybe certain market participants taking a bet that valuations have corrected enough for certainly it's a buying opportunity for some stocks. As we're hearing from Eddie van der Walt, maybe it is about stock picking in today's markets. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The future of Hong Kong's electoral system remains in the focus at China's National People's Congress. Critics are concerned the changes will just tighten Beijing's on the financial hub. Asked what kind of criticism will be allowed after the new legislation, the city's top legal official is warning residents not to stray too far from the facts.
Criticisms that are fair and rational and fact-based would, of course, be well taken, because in a democratic society, one needs to take those on board and then analyze it in order to formulate the policy.
U.S. airlines are urging the Biden administration to take the lead in developing a temporary virus passport to help reopen global travel. Industry leaders say the White House has to act quickly to develop these standards to support the industry. It comes amid a significant slowing of infections in the U.S. despite an uptick globally. And a Swiss pharma company will begin producing the Sputnik COVID-19 vaccine in Italy, the first European production of the Russian shot. No targets are being set, and production is subject to approval from Italian regulators. It comes as Prime Minister Mario Draghi is vowing to speed up Italy's vaccine drive. 100,000 Italians have now died from the coronavirus. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the tech sell-off in the U.S. has sent ARK Investment Management's main ETF to its worst loss in a year. It's now wiped 30% from the company's flagship investing strategy after last month's high. Well, founder and chief executive Cathie Wood says she's keeping her eye on the prize, sticking to her highest conviction names, including Tesla. She spoke with Bloomberg's Emily Chang.
When we go through a route like this, first of all, the rotation now is happening very quickly. It started off slowly and is happening quickly. So I'm happy that the market is broadening out. This was the case in late 16 as well. Value took off and left growth behind. And whenever I see that happen, I say, okay, this bull market has broadened out. This is good news. What we do during these periods is concentrate our portfolios towards our highest conviction names. And so that's what we're doing. We had extended the number of names in the portfolio from the low to mid 30s at the bottom of the coronavirus. And now we're at roughly 55 for our flagship fund. And we are starting to sell the more liquid names and buy some of the more pure play names. So the more liquid names are either more mature, the Facebooks, the Apples, and so forth, or they are participating in innovation, but they're not pure plays. So Regeneron, Novartis, and so forth. So more liquid, in order to have cash-like instruments to use at a time like now, and move, again, concentrate towards our highest conviction names.
So let's talk about Tesla then. You said that you were only going to buy the dip. Are you going to continue to buy the Tesla dip now that it's dipping even lower?
Yes, we can buy a stock up to 10% of our portfolios. And that's certainly in the ETFs. We report our holdings at the end of every day, so anyone can see that. And yes, we have been building whenever we can. Now, we built up to 10% last week, so the stock behaved in line with our portfolio. So again, we can't buy anymore here. If it were to deteriorate at a rate beyond that of our other portfolios, so drop below that 10%, we would then have the latitude to buy more, of course.
Now, you've said you're going to put out a new Tesla price target. The market is anxiously waiting for that. When are we going to see that? Can you give us an idea of what the target will be?
It's going to be I'm going to say a couple of weeks. We're getting compliance is helping us cross our T's, dot our I's, and do everything we should do before we send it out. The margins in autonomous, the gross margins, are in the 80% range. The margins for electric vehicles alone are in the 25 to 30% range. This is a 5-year projection. So the model changes completely if Tesla gets autonomous right, and we think it will.
Well, that was ARK Investment Management founder and chief executive Cathie Wood. This is what we're seeing in terms of gains in pre-market trade for ARK Innovation ETF. Those shares up some 4.03%. Yesterday, they were down 6%. Now, coming up, women bore the brunt of the pandemic slump in the labor market, according to the new data from the World Economic Forum. We'll be speaking to the managing director of WEF, Sadia Sahidi, ahead of the organization's gender pay gap report. This is Bloomberg.
Just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. The destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
Come to a place like this and be able to break some stuff and release some tension without going to jail.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The
labor force rate for women now is much lower than for men.
You need workplaces that are truly inclusive, that break down the barriers that keep women and people of color and LGBTQ disabled workers from not only coming into the workforce, but staying in the workforce.
Female business leaders are actually saying that household chores are impacting their work.
I think some of the things that are being contemplated as well in terms of the minimum wage and increasing the minimum wage to allow women to be able to afford childcare is critically important as well.
I would argue, and it's a frustrating argument to make, that women are dropping off even before the stage in which they're having babies.
We make up a disproportionate share of those low wage paying service sector areas of the economy. So of course, if I put it in the context of COVID, we were hit tremendously harder.
Some of our guests there on International Women's Day talking about the impact of the coronavirus on exacerbating inequality between the genders. Well, new data collected by the World Economic Forum and LinkedIn shows just how much more vulnerable women's jobs are during economic shocks. Women, as a share of new hires at the height of the pandemic, slipped to just 42% in the UK and 44% in the US. Those numbers have improved in 2021, but still lag behind men. Well, joining us now for an important conversation is Sadia Zahidi, World Economic Forum Managing Director. She's also the author of the WEF's Gender Pay Gap Report, which will be released at the end of this month. And Sadia, you've done so much work on this to try and understand it from an economic point of view and also give politicians the tools they need to make things better. So thank you so much for joining us. What are you seeing during the pandemic?
So last year, when we looked at the trend over the last decades, we found that when you project outwards, it's going to take 99.5 years until we reach parity. And the unfortunate news is that what we found with the latest report with the data from this pandemic is that that's going to get worse. We were already looking at several generations before we reach parity. So this pandemic has been a calamity for women in the workforce. And there are a number of reasons for that. I think what you pointed out there is about, are companies starting to revert to old behaviors? Are they starting to do what they used to do in terms of hiring and retention and promotion? So that's one element. A second element is that women are having to take on a lot more of the caregiving responsibilities in the home, and in particular with school closures, that's leading to a strong impact in their ability to work. A third element is the types of sectors that have been disrupted. So whether that's sort of, the tourism industry or the hospitality industry or retail, these tend to be large employers of women, and they're the ones that have suffered the most in terms of job losses. And then finally, fourth, the roles that are growing, the very sort of digital intensive roles in the white collar workforce, those tend to have a much smaller pipeline of women. So all these factors together are creating this sort of perfect storm in terms of a retrenchment of the gains made for women in the labor force.
So, Sadia, if you look at the global gender gap, it's widening. How quickly can it, become narrower again? Once the economies reopen, a lot of schools are now reopening. Is it hard for women to get back into the labor force?
Yeah. So this is where I think, as much as there is very bad news, at the same time, this is a moment at which politicians and business leaders can actually come together to create a very different kind of workforce in the new economy. And there's a few ways to go about that. One, we know that the care economy is actually a big job creator. And so that also tends to be not just an employer of women, but actually addresses some of the imbalances in the home in terms of women's work and men's work. So that's one area to invest in, and governments would do well to focus on that. A second area is this whole movement around ESG and stakeholder capitalism. Done right, this will actually lead to the right kinds of metrics for businesses to focus on in terms of gender equality, but also other forms of diversity, equity, and inclusion. Third is skilling. So we know that there is a massive reskilling revolution that's needed if we want to train workers up for the future. If we do that reskilling revolution without a gender lens, we're again going to create a bifurcated labor market. So there needs to be that gender lens. And then finally, a big focus as governments think about the next wave of their stimulus and they think about supporting small and medium-sized businesses, they again have to apply a gender lens, because again, this could be a golden opportunity to actually support more of those women-owned businesses.
But Sadia, are policymakers really taking action, or is it only talk for the moment? What's the time, how much time do you need to figure out whether they put real policies that make a real difference into the economy and women?
So I think overall, there needs to be a lot more coordinated global focus on the economic recovery. And then as part of that global focus, there needs to be a lot more focus on inclusion and social justice, as well as gender equality. So to answer your question, I think not enough is being done, and a lot more does need to be done. And of course, one element of that is to ensure that both male and female politicians are also part of these conversations. And that's where there's a bit of a vicious cycle going on, because also when it comes to political empowerment and the number of women that are present in ministerial positions and parliamentary positions, especially in some of the biggest economies in the world, there has actually been a loss of some of those gains too. And so we're seeing this double impact, which is coming not just from the workforce, but also in terms of who the decision makers are.
Sandhya, does it make it easier because we are rebuilding the economy on the back of a pandemic, or does it make it harder to put some of these policies in place?
So I think what's interesting is because this is a moment of rebuilding, we actually can get things right if we put the outcome front and center. And if we do want more equal economies, then this is the moment to start putting in place some of these targets and metrics for bringing more women into small and medium-sized businesses, bringing more women into the white-collar workforce, rebuilding some of these sectors with a view to gender equality, and as I mentioned, ensuring that training and reskilling is also gender equal. So in many ways, this is easier because everything's on the table, but that does require a concerted effort and focus on the part of both politicians and business leaders. And I think this is where looking at the corporate sector could be quite helpful. While we're seeing some of this pullback from some businesses, the ESG and stakeholder capitalism related movement, where a lot of the big businesses are quite bought in, particularly in Europe and in the United States, I think that's where one part of this movement could come from.
Sandhya, thanks so much. Sandhya Sahidi there, the World Economic Forum Managing Director, of course, is spearheading all of the work on gender and diversity through the lens of economics. So it's really important. And that report out of the World Economic Forum out a little bit later this month. Now, let's also check in on NASDAQ futures. Overall, the markets are still going through this rotation. Now, yesterday, we saw some big losses on NASDAQ. Now, futures are gaining 2.1%. But overall, government bonds across the globe seem to be rallying. But there's that U.S. debt auctions that, of course, have the potential to spark volatility. I think I'm going to have a very open, animated discussion about inflation with our Matt Miller also in 30 minutes from now. Now, coming up, an activist investor in UniCredit opposes its incoming chairman. We speak to Francesco Trapani, Bluebell Capital Partners co-founder and former chief executive of the Italian jeweler Bulgari on his latest activist campaigns and the European luxury market. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Great Rotation tech stocks take another hit overnight as the Nasdaq enters a correction. Futures point to a rebound. Eyes on the prize, Cathie Wood's ARK ETF suffers its worst losses in a year, but the cult fund manager tells Bloomberg she's doubling down on high-conviction names. Her flagship innovation fund gains in pre-market. And there's tools for that. Well, Janet Yellen plays down fears that President Biden's $1.9 trillion stimulus could provoke runaway inflation. But the biggest yield GDP gap in over half a century suggests a bond sell-off has further to run. Well, hello, everyone. I'm Francine Lacqua here in London, and this is Bloomberg Surveillance, the early edition. Now, Bluebell Capital Partners, an activist investor in UniCredit, has opposed the bank's appointment of the former Italian finance minister Piercarlo Padoan as chairman. Bluebell questioned his independence because of his role in the bailout of Monte Paschi, a possible takeover target for UniCredit. Well, Bluebell Capital Partners was co-founded by Francesco Trapani, the former chief executive of Italian jeweler Bulgari, in 2019. UniCredit is the latest activist campaign in Europe, following moves at asset management GAM and French yogurt giant Danone. Well, Francesco Trapani joins us now. Mr. Trapani, thanks so much for joining us. I know we have a number of targets to talk about and some of the things that you want to do, including private equity. But first, on UniCredit, what exactly is your base case? So we have a new chief executive arriving, and you think the chairman's not the right person because of his past.
As you said, the bank is something that we like a lot. It's a strong bank with a strong competitive position at European level, strong balance sheet. A new CEO coming, Mr. Sen, that we like a lot. So there are plenty of things that we like, and the stock price when we invested was at the right level in our opinion, so we have invested. Now, the thing that we don't like at all is the possibility that there is a combination with Monte Paschi di Siena, for, I would say, obvious reasons, considering the past. So we are against that. And we think that Mr. Padoan is a reputable person. He is not the right person for being a chairman because he's not independent, considering, let's say, his past, recent past, and also the implication with Monte Paschi di Siena in the past.
Mr. Trapani, are you expecting more activist investors in general? Do you have support from others? And do you think the kind of activist investor movement that we're seeing in the U.S., will it ever be as active in Europe and especially in Italy?
Well, I would say that in the last campaigns that we are involved in, like Danone, for example, and also on UniCredit, of course, we are talking with a lot of international investors. There is no concern with them, but still we exchange notes. And we know that there are a few very big investors that are by and large aligned with our theory on UniCredit.
When you see some, so you're also involved, of course, in private equity. There's so much money out there. Does it mean that there are too many private equity actually looking for the same targets? And how do you differentiate yourself in this kind of environment?
Well, yeah, it's true that there is a lot of money to be invested in private equity, and this is, I would say, in worldwide, also in Europe and Italy. There is a lot of interest anyhow in the entrepreneurial segment, at least in Italy. As far as we are concerned, we've been very, very active in the last few months. We've done 4 different deals in the second part of 2020, notwithstanding the pandemic. So we are happy with last year. And today we are looking into different projects, very exciting too, although not mature yet. So as far as we are concerned, we are pretty happy with the outcomes in Italy for the private equity activity. Although I have to say that we normally invest in companies that are of limited size, so maybe with less competition in the market.
What are you targeting? Is there anything, I know you have, a very successful past in luxury. Is this the next frontier? Is it something that you would see as attractive that you could turn around there?
No, let's say VAM Investments, the company that I control in Italy for the private equity activity, is a good mix of financial expertise and entrepreneurial expertise, considering my presence. And this is particularly interesting for the entrepreneur in Italy. So we normally have a good traction with them. And we are, if you like, generalists, so opportunistic. We don't invest only in one single segment. Although I have to say that luxury and consumer in general, is the area where we are more active because we have more traction with the local, with the entrepreneur. Although, to be honest, we are presently studying other things that are not consumer.
Mr. Trapani, where do you see the main risks in private equity at the moment?
Well, no, it's always the same. When you are wrong in evaluating a company and evaluating the potential growth of the company. As a matter of fact, we normally invest in growth companies, so we don't do normally restructuring. It can happen, that is not our matter. So the risk for us is to be wrong mainly in measuring and asserting the potential for growth of the company that we look into. But I have to say that what we've done last year is paying out well. I mean, the companies are doing at least in line with the business plan or even better. So
will private equity deals get bigger? And again, which sponsors will remain successful in the future?
Well, if I look at us, what I can say is that we don't act through a fund. We do deal by deal, and we finance the deals with our money and the money of a certain number of private and institutional investors. So we are much more flexible. We can actually adapt our structure to the opportunity. Otherwise, of course, I mean, you have the very large companies that everybody knows that are the ones that are dominating the market, and probably they are maybe not the best performing in terms of IRR, but certainly they are very, let's say, are companies that can have a more constant performance than others.
Thank you so much for joining us today. Francesco Trapani, there, Bluebell Capital Partners, co-founder and former Bulgari chief executive. Now, investors concerned about bad loans in Greece. Can an increase in interest rates actually turn the Greek economy into a tragedy? Well, up next, we discuss that with the chief executive of one of the country's biggest banks, Vasilios Psalitis from Alpha Bank. If you have any questions for him, just IB us, or you can IB me directly. You can do IB plus TV Go. This is Bloomberg.
Expect that face-to-face learning is the ideal, but I don't think that we are ever going quite back to that. What we're seeing is more of this integration of the technology into the day-to-day. We have seen that schools have had this kind of trial by fire in terms of trying to reopen successfully, and that many schools have had to use a system of using different ideas around what it would take to reopen and then pivoting when those ideas did not work well, meaning that some have had to go back and had to close. And that's been a global challenge.
We're in the beginning of 2021. What are your biggest worries?
The inequality of the current world environment. It's troubling, and I think it's actually getting worse, which is a big challenge.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Barclays is said to be planning job cuts at its corporate and investment bank as part of a wider cost-saving measures. Bloomberg sources say around 60 positions will go, including some senior roles in the US. COVID-19 has slammed the bank's lending business, and it sees that continuing this year. No comment from Barclays. Now, Greensill Capital has filed for administration in the UK, capping a stunning collapse for the supply chain finance firm. Key backers walked away over concerns about the valuation of the company's assets. That includes Credit Suisse freezing and then winding down $10 billion of funds that bought Greensill products. And Vodafone is looking to raise as much as 2.6 billion euros from a listing of its European mobile phone towers unit in Frankfurt, one of the region's biggest IPOs this year. The UK telecoms giant plans to sell shares at up to 29 euros apiece. Carriers are looking to squeeze value from their mast and fibre assets as they are hit by increasing competition and regulations. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, Europe is concerned about Greece's bad debt. Greek banks have the highest proportion of bad loans on the continent, and despite shedding about a third of their non-performing loans since 2015, they still make up about 40% of total lending. Now, last year, Greek banks deferred loan repayments on 30 billion euros to help 400,000 borrowers cope with the fallout from COVID. This loan repayment holiday is coming to an end soon. There are concerns that a return to normal repayments by borrowers weakened by coronavirus lockdowns could also add to the bank's already high levels of impaired loans. Now, could an increase in interest rates bring a wave of defaults? Well, joining us now is Vasilios Psaltis. He is Alpha Bank Chief Executive Officer. Alpha Bank, one of the country's biggest banks, and recently it also agreed to offload nearly 11 billion euros of toxic loans to U.S. hedge fund Davidson Kempner as part of the Greek government's efforts to clean up bank balance sheets. So, Mr. Psaltis, thank you so much for joining us. First of all, can you talk to us about some of the bad loans that you're seeing at Alpha Bank? How much have they increased because of the pandemic in the last 10 months?
Well, good morning, Francine. Thank you very much. Now, I think we should firstly look at the big step that we have been able to conduct, as you rightfully pointed out. There was a catalytic event, actually, that allowed us to move very fast forward. From the period of 2017 to the period to the end of 2019, the Greek banks have been able to shed 36 billion, but still 65 billion of non-performing exposures were there. At that point, the government introduced a scheme which has been very popular in Italy, so-called Hellenic Asset Protection Scheme, which allowed practically for jumbo securitization to come in, as the government has been giving its wrapper to the senior tranche of NPE securitization. So within 1 year, Greek banks have been able to conclude 31 billion of securitizations, which actually are taking the NPE number in the sector down to 33 billion. And this is also why Alpha Bank has been able to do this practically the second largest rated transaction in Europe for 10.8 billion that allowed us to shed a significant number down of NPLs down to 13%. Now,
so, Mr. Psaltis, what comes up next? So you've done that. Right. Are we going to see more securitizations? Are we going to see new bonds being issued?
Well, firstly, let's have the bond issue first out of the way, because Alpha Bank has been able actually to issue right immediately thereafter a lower tier 2 transaction for 500 million. That has been 1 year after our inaugural 500 million transaction. And that has allowed for replenishment of capital buffers. Total capital ratio now is up to 17%. So that was an immediate action after the transaction. But I think we should spend 1 minute in describing how we have viewed the pandemic over here in Greece. And that has been quite positively compared to elsewhere in Europe from two fronts. The government, number one, has been very focused on the health issue, and so the performance that we've seen here in Greece is much better than the European average. But secondly, also the government has been able to move forward with a very strong fiscal stimulus, focusing on two things. Number one is making the unemployment capturing at that level. You know that Greece has with 16% the highest unemployment in Europe. So by focusing in giving handouts, but at the same time also promoting liquidity through the banking system with a condition precedent of keeping the employment, they have been able actually to maintain unemployment and further expectation building in the country, in fact. In addition to that, however, also the banking system has been very fast in moving forward towards supporting its customer base. On the one hand, by embracing moratoria, according to regulatory guidelines that we have received, 22 billion of performing loans have been into moratoria. That's 15% of the performing loans in the country. And on top of that, we have been able to grant new disbursements to the tune of 18 billion in order to replenish working capital so that companies immediately going out of the lockdowns would be able to start working as close as normally again. Yeah. So that is, that is actually the...
Sorry, finish.
Yeah, so I was about to say that this puts Greece in a good proposition. So on the one hand, still dealing with the legacy assets, and on the other hand, also being in a good starting position in order to address whatever new NPEs may come out of the moratoria. Especially on the latter, I should also refer to 3 data points, which I think that are important. Number one
before
is
we get to
yeah, sure.
Mr. Psaltis, let me just, before we get to the data points, do you think Greece needs a bad bank? This is something that the Bank of Greece has put forward. Do you believe this is the right time to put it in place?
Well, indeed, the governor and his team have spent a considerable amount of effort and time in order to put forward a concept. And we, as Greek banks, are coming together in order to take a position and answer also back to the government on that scheme. I think an initial reaction to that is that whilst the Hellenic Asset Protection Scheme is a very strong instrument to deal with the late delinquencies in our portfolios, a bad bank could be a more flexible instrument to deal also with other cohorts as far as the non-performing exposure is concerned. So given where we are in the crisis, this provides an interesting proposition in order to capture the whole of the NPE space.
Mr. Palsi, talk to me a little bit about how the money from the EU, the EU Recovery Fund, should be spent. What would be your #1 priority, and how quickly does it need to be spent there?
Well, the EU Next Generation Fund, particularly the RRF, this is something that Greece has been very focused in capturing. It has 2 legs. On the one hand, there are 19 billion of grants, which makes 10% of GDP of 2020, that will focus, according to the guidelines, on at least 20% on digitalization. And this is something that Greece has to catch up quickly. And then 39% also on the Greek economy. This is something where Greece has a natural comparative advantage. On top of that, however, there is also a second leg with 13 billion, and that considers loans. Now, on these loans, on the one hand, they will need to focus on a few criteria, which is that they will promote exports, R&D, but also to grow the average size of the Greek companies, potentially through M&As. And then banks are the ones actually that are going to be doing the bankability checks. So in such case, if a company is able to procure 20% of equity, and we banks consider those projects bankable, and we procure the remaining 40%, then the other 40% will come from the RRF. That means that we're going to be able very quickly to mobilize mature projects in order to boost GDP. That is an important development.
Mr. Palsi, thank you so much for joining us. Vasilios Paltis there, Alpha Bank Chief Executive Officer. Now, in the meantime, this is the rotation that we're seeing in the markets. Now, we saw it yesterday. Today, there's a bit of a reversal in terms of what the NASDAQ is doing. So let's bring the board up so that we check on all the markets. It's very clear that U.S. equity futures are now surging. There's basically, if you look at the tech stocks, they're up after the NASDAQ yesterday entered a correction. Now, government bonds also across developing markets. I'm looking at my Bloomberg terminal. Extremely useful when you look at markets. A lot of the government bonds across developed markets are rising before a series of treasury auctions that could also see a bit of renewed volatility. Now, it's almost back to normal as long as you're vaccinated. The CDC tells Americans they can meet indoors without masks if they have received their shot, actually the 2 shots, fully vaccinated. But can spring break get in the way of recovery? Up next, we discuss all things COVID and vaccines with Sam Fazeli, Director of Research at Bloomberg Intelligence. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Fully vaccinated people can visit with other fully vaccinated people in small gatherings indoors without wearing masks or physical distancing. Remember, here we are talking about private settings where everyone is vaccinated.
Well, that's a message from the CDC to all Americans. If you're vaccinated, you can visit other vaccinated people indoors, mask-free, and without observing social distancing. Well, joining us now is the Director of Research at Bloomberg Intelligence. He's our very own Sam Fazeli. Sam, I want to get back to what the CDC said in just a moment, but I think about 30 minutes ago, we heard that the Pfizer-BioNTech COVID shot actually neutralizes Brazilian strains in lab. How significant is this news? I guess the main question is whether the vaccines that we're taking will be good enough to also counter these new variants.
Sure. Good morning, Francine. I'm sorry to be the harbinger of bad news, but that's actually not news. That's just the full version of the so-called peer-reviewed paper of data that we've seen from that group a few weeks back. And I'm a little not skeptical. It is what it is. The data are what they are, but they don't actually use the variants themselves. They have engineered things that look like the variants. And I think we have enough data around to show us that when you test the vaccinated blood against the actual variants in various assays, you do see a 5 to 6-fold to 8-fold drop in neutralization. But that, as we've said, Francine, is not the end of the story. There's a lot more going on here. You have your cellular immunity. These vaccines will be effective, very likely, at a good level against severe critical disease.
So what do we know about the vaccines? Yesterday, we had these new guidelines from the CDC. Does it mean that once you're vaccinated, fully vaccinated, if it's 2 shots, you need the 2 shots? Does it mean that you can't test positive? Does it mean that if you are exposed to COVID-19, that then you can't pass it on?
No, it doesn't mean that at all. I think what the CDC is trying to get to is that if you have been fully vaccinated, which is the objective that we've all got at the end of the day, you can resume some semblance of normal life. And if everyone in the same room is fully vaccinated, the risk of developing severe critical disease is much, much, much lower. Unfortunately, we don't know exactly how good the vaccines are in blocking the catching of a virus and of an infection or passing it. So, but that really doesn't matter if all we're talking about is the sniffles, as everyone's calling it.
Sam, the EU-AstraZeneca fight rumbles on, and now we know that the Russian vaccine will still be soon in the summer also be done in Europe. How will this end? Will Ursula von der Leyen be able to vaccinate the citizens of Europe in enough time?
Yeah, that's a good question, actually, Francine. Unfortunately, if it was literally just up to her, I don't think we'll get anywhere near vaccination levels that we would need to, possibly simply because you need the armies of pharmacies and local doctors, and I was just talking to our local pharmacy here yesterday in France. They're getting ready for the AstraZeneca vaccine next week. So those are the vaccines, that one, the J&J vaccine, and the Sputnik V, which have got refrigeration as opposed to freezing requirements, which are much easier to manage. But it will take 2 or 3 weeks, I think, for people to get used to the pharmacies and local doctors actually getting these vaccines to people and making sure that they don't waste doses.
Sam, thank you so much. Sam Fazeli, their Director of Research at Bloomberg Intelligence, of course, following vaccinations and COVID-19 very closely. Now, the markets, it's all about the markets today, and of course, the rotation that we saw yesterday with futures up, stocks up here in Europe. Bloomberg Surveillance early edition continues in the next hour.
their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm happy that the market is broadening out. This was the case in late 16 as well. Value took off and left growth behind.
Like all of the manias, there will be choppiness, and I think you will see sharp corrections.
Fully vaccinated people can visit with other fully vaccinated people in small gatherings indoors without wearing masks or physical distancing.
This is Bloomberg Surveillance, early edition with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning, everyone, from London, Berlin, and New York on this Tuesday, March the 9th. Our top stories today. The great rotation, tech stocks take another hit overnight, but the Nasdaq appears to rebound this morning. Is it time for value to shine? Eyes on the prize. Cathie Wood's ARK ETF suffers its worst loss in a year, but the cult fund manager tells Bloomberg she's doubling down on high conviction names. More from our interview shortly. And there's a tool for that. Janet Yellen plays down fears that President Biden's $1.9 billion stimulus could provoke runaway inflation. The biggest yield GDP gap in over half a century suggests a bond sell-off has further to run. There's a lot going on. We also have OECD figures just crossing, but actually, I know Matt wants to talk deeply about inflation. There's this huge debate, Matt, going on with economists saying, look, there may be a little bit of inflation. The Fed can look through it just because it's not that kind of sticky inflation. And I know you're looking at a different kind of metrics, including rents, and think that maybe inflation could be here to stay.
I mean, I have so much to say today, Francine. I don't know where to start. Inflation is a good place. The kids are expecting rents to climb. In the U.S., expectations for rents to climb are at a record, and that's not the kind of inflation that turns around. That's not transitory, right? Your landlord doesn't raise your rent 10% over the next 2 years and then drop it for you 20. I mean, that just doesn't happen. So, and then Janet Yellen saying we have tools for this. That's what Ben Bernanke was saying back in 2010 on 60 Minutes. Like, oh, inflation, don't worry. We can stop that when we need to, and I think the market took that a little with a little bit of grain of salt then. Yes?
Matt, you know, just like when, you know, you have a new boyfriend or whatever, husband, you write the pros and cons. This is what I did this morning about inflation. It's like supply chain, you know, some of the supply market and the money supply and things like that. So we'll break it down. We're also getting some OECD figures, and actually they're raising global GDP to around 5.6% a little bit later on. Also, we'll be speaking to the chief economist. Now, with the markets, Kaylee, it's all about rotation.
It is all about rotation, at least here in the U.S., Francine. But I do want to start with what we saw in the Asian session, specifically in the Chinese markets, because despite intervention from state-backed funds, the CSI 300 still ended the day 2% lower. Worst four-day losing streak since all the way back in February of last year, and that was the height of COVID concerns. Here in the U.S., though, that rotation looks to be on a bit of a pause. Big tech trying to stage a rebound come the U.S. Open in about 4.5 hours' time. NASDAQ futures pointing higher by 2% after a nearly 3% loss yesterday. So maybe a bit of dip buying coming in, and helped out by the fact that yields are moving lower, down to just 1.53% on the 10-year. I would point out, too, that with yields moving lower, the dollar is weaker for the first day in 5. As for some stocks on the move, again, it is all about that momentum comeback. We're attempting to stage a comeback. Tesla up about 4% in pre-market trading, looking for its first gain in 6 days. Apple is rebounding off of its worst day since all the way back in October. Churchill Capital, the SPAC, higher by about 4% in pre-market trading. And then GameStop, the saga just never ends. Higher for potentially a 5th day in a row. A lot of optimism about Ryan Cohn, the Chewy founder, leading its e-commerce shift, is up 18% in pre-market trading. As for what is ahead on this Tuesday, we do get some economic data at 6 a.m. Eastern Time. The NFIB Small Business Optimism Survey for February. Play close attention to the price mechanism in that for any kind of read on inflation. Then at 1 p.m. we get the Treasury auction, $58 billion in 3-year notes. What will demand be like? And if it is weak, does that lead to another sell-off in the bond market? And then all day today, we are watching Capitol Hill as the House is expected to take up that $1.9 trillion aid package, Matt.
There is, by the way, there's still a lot of things that I want to talk about today, with the president of the European Commission blaming a small company, I mean, in relative to Europe, you know, for the lack of vaccinations. You've got the new Bitcoin highs that we're going to, I'm sure, talk about today as well. And the rotation really is, in terms of markets, my main focus. Take a look at this terminal here, the Dow beating the NASDAQ by the most in a decade. There are so many different charts you could use to illustrate this rotation. I think this is one of the most striking, but there are many. This is mine. It's just amazing that value is finally looking like it's going to come back and beat growth. But I wonder if this is a head fake. We've seen a few in the past, but none the likes of this. The highest we've seen the Dow beating the NASDAQ since 2008, Francine.
Yeah, Matt, I really want to talk about AstraZeneca and the EU with you, so we'll get to that shortly. But now back to rotation and back to inflation expectations or not. This morning we're joined by Trevor Greetham. He's head of multi-asset at Royal London Asset Management. Trevor, Matt and I going backwards and forwards in terms of inflation, the case for inflation, money supply, the case against money velocity, case for loose labor markets, case for inflation, supply shocks. Are we going to see inflation that will actually change the path for the Fed or not?
Well, yeah, I think we're going to see quite a lot of inflation in the next few months. And obviously, mechanically, you're going to have the year-on-year comparison to last April, May, when oil futures were trading at negative prices. So you're going to get lots of news flow this month and next month and the month after, which will look like inflation's really out of control. And we're seeing a lot of pricing power in the industrial survey. So it's not just about year-on-year comparisons. So the world economy is coming back quite strongly in the next year or so. Supply is probably constrained a little bit by social distancing. Sure, I think you will see enough inflation for people to get a bit more worried than they currently are. And I think there's room for the yield curve in the US to steepen quite a bit more. It's already at 140 basis points, 2s, 10s, but we got up to nearly 300 in 2008, 9, 10. So I could easily see, you know, US 10-year yields above 2%. So I think there's more to go. And whether it's on a straight line or not, I don't know. But if you look at prior times that the yield curve, well, if you look at prior times the yield curve has steepened, it doesn't pause for breath. It could happen in 3 months. I mean, the yield curve steepening, when it happens like a rocket.
Okay, and there's, I mean, this is, you know, one of the best charts that actually Kaylee and Matt were also talking about is the fact that you're seeing this widening gap between GDP and actually what we're seeing in Treasury. Does it mean that this is just the beginning of the rotation overall for all markets?
I think so, because if you look at the degree of underperformance that happened to value stocks last year, it's off the charts. So if you like, there's an elastic band that's stretched, and it's very stretched, and you don't kind of get back to normal by having a week or two with value doing a bit better. The overall market level is quite critical here, because it could be that the overall market gets impacted by the rising bond yields and the sell-off in tech to such a degree that you have a broad sell-off. So you could see a broad sell-off, but what I'm describing to people, though, is, as you've described it, a year of rotation where there's a bull market in deep value and reopening plays, and there's a bear market in expensive tech and government bonds, the winners of 2020.
I wonder about the possibility of the Fed stopping inflation dead in its tracks in case it pops up. You know, we heard this from Bernanke on 60 Minutes 10 years ago, and now Janet Yellen, she was on MSNBC yesterday saying she really doesn't think that inflation is going to pick up. It's interesting that she and Powell are so adamant that this is only transitory and not going to hurt. She says if stimulus turns out to be inflationary, and how could, you know, $5 trillion in stimulus be inflationary? There are tools to deal with that. How come the Fed is so sure of its, or she's at the Treasury now, but was at the Fed, so sure of their ability to be able to stop inflation, you know, without decimating the economy?
She didn't say that bit. So, you know, Paul Volcker proved that you can destroy inflation by decimating the economy, and the Fed does have tools to decimate the economy. So I think what Yellen's really saying, though, is they're happy for inflation to overshoot. In fact, they're more comfortable with inflation overshooting because they know what to do to slam the brakes on than with inflation dropping dramatically. And there's a massive uncertainty here because we just don't really know what the output gap in the economy is, because we don't really know what the proper unemployment rate is. And, we don't know yet the path of COVID. So there's lots of uncertainties. And what the Fed's basically saying, though, is they're happy for inflation to overshoot, which is the new mandate they've got with an average inflation target. And I think around the world, you're going to find central banks generally happy for inflation to overshoot because it's a way of dealing with debt burdens.
In terms of, we know, Trevor, now that the Pfizer vaccine stops all these variants. The CDC today saying that vaccinated people can meet with vaccinated people indoors without masks.
Right.
Like, if that weren't the case, why are we doing this in the first place? That's the most NINSS statement I ever heard. What are your real concerns in terms of headwinds? Yes, if there's another huge pandemic, I get that, but the likelihood is that we're well on the way of fixing this.
Yes, I agree with you. I think the biggest concern has got to be in the growth sectors, because if you look at the US market, technology alone is close to 30% of the market capitalization, and it's a volatile sector. So I think you could have an environment where it's better to travel than to arrive. And if you're in the broad indices, stock prices are going down, but commodity prices, I think, would still be going up, and value sectors would still be going up. And the kind of years, you've got to been around the block a few times to remember, but it's years like 1994 when commodities went through the roof, but stocks actually ended up about 10 or 15% down over the year. That's the kind of environment I think is the biggest risk, that you get a big rise in bond yields, unsettling markets, and it will come in possibly 2 steps forwards, 1 step back. So there will be some point where the markets rally off a depressed level of sentiment. And the real question is, at what stage does the Fed actually come in and say, look, yields have gone too high, we want to do something about it? I think the most likely reason for them wanting to do that, though, is that they think that rising bond yields is hurting the housing market. And there's not a lot of sign of severe pain yet in housing.
So then what do you do to protect against downside risk, Trevor? Do you hedge with commodities? And if so, which ones? Because gold is not acting in that way at this point.
No, gold tends to do well when real yields are falling and they're rising, and gold tends to do well when the dollar is weak and the dollar is strong, and gold tends to do well when you're heading into a pandemic, and hopefully we're heading out of a pandemic. So gold isn't the obvious choice, but a broad commodity exposure like the Bloomberg Commodity Index, there it is on the screen, that works quite well. It's about 1/3 energy, 1/3 agriculture, 1/3 metals. I think that would be okay. And I think that stock markets like the UK, much, much cheaper than the US. The UK is on 15 times 10-year earnings on the Shiller measure. The US is on 30 times. So you've got cheaper markets out there to rotate towards. And our multi-asset funds tend to have more UK equities in, they have commodities in, they have commercial real estate, which could also start picking up, even if stocks are dropping in 2021.
Trevor, thank you so much. Trevor Greetham there, head of multi-asset at Royal London Asset Management, talking about rotation and, of course, some of the commodity stocks. Now, coming up, Nikolai Setzer, Chief Executive of Continental, one of the world's largest auto parts maker. I know Matt Miller is looking forward to that interview. And then later today, Mark Mobius, Mobius Capital Partners founder, talks emerging markets. That's at 3 p.m. in London, 10 a.m. in New York, and this is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Fully vaccinated people can visit with other fully vaccinated people in small gatherings indoors without wearing masks or physical distancing. Remember, here we are talking about private settings where everyone is vaccinated.
That's the message from the CDC to all Americans. If you're vaccinated, you can visit other vaccinated people indoors, mask-free, and without observing social distancing. This news comes amid a significant slowing of infections in the U.S., though global cases are picking up speed again as variants spread rapidly in places like Europe. Sam Fazeli, Director of Research at Bloomberg Intelligence, joins us now. Sam, the CDC guidance, Matt is saying, obviously, the point of vaccinations is so you can meet with a vaccinated person as if everything is normal, but you still, the CDC says, shouldn't travel. You still should wear your mask in public. Is this just coming down to a transmission question and then we still just don't know enough about a vaccinated person's ability to spread the virus?
Absolutely, absolutely. So here, I think the CDC director used quite a lot of caveats. Fully vaccinated, indoors, only people who've been fully vaccinated. So the point here is, even if you've had your full doses of vaccine, you can still catch an infection and you can still be a risk to people who haven't been vaccinated. So we can't let our guard down.
Yeah, I saw that. Actually, you did a story with another Bloomberg opinion columnist who was wondering how could she possibly get sick if she was vaccinated. And clearly, that's a possibility. I get vaccinated for the flu, Sam, every year. I still get the flu fairly often. Is this vaccine going to be better than the flu vaccines that we've gotten in the past?
Cannot answer that question, unfortunately. We have to wait and see. We're all dealing with efficacy that we're measuring, effectiveness we're measuring in our societies a month after we've got people fully vaccinated. We need a lot more data and a lot more time to really figure that out.
Okay, but Sam, overall, are you confident that we're going at the right speed, that enough people are getting vaccinated, and even Europe, although they're blaming AstraZeneca, will sort it out and get enough people vaccinated quickly?
Absolutely. I hope that every country gets there in the end, and I hope that every country beats every other country in the race to the vaccine end line, which of course is impossible. But I mean, look, I'm so confident in these vaccines that I'm going to put myself through a major trip back to the UK to get my first dose, which I've been invited to have. But we have to be realistic. We don't know how well they work against the variants, despite the paper that's just been published, which unfortunately is being a bit overblown. And we don't know how long the immunity lasts. That's just because we don't know. It doesn't mean that it won't. We just have to wait and see. And I'm expecting and hopeful that we'll get a new booster shot for the variants too.
Sam, I'm based in the UK, so I actually find it quite shocking that there are people in Europe, in Germany and France and Italy, refusing the AstraZeneca vaccine. Now we hear that the Sputnik V, the Russian vaccine, will also arrive in Europe and be produced in Europe in the summer. Will that be a game changer?
Well, you know what, Francine, we've looked for game changers all along. The game changer is for the European Union to get its act together. Should have done it faster, but doesn't matter now, looking forward. Get as many doses as they can for effective vaccines, which all of the ones you've mentioned so far have proven to be the case, and organize the system and the logistics to get into people's arms and stop going on about different ages and all that and undermining the confidence in these vaccines.
Yeah, clearly the EU simply dropped the ball in a major way. The point about the logistics of getting it into arms falls down to each country, right, Sam? I mean, we've got to deal with the German bureaucracy if we even get the doses to see if they can spread it around, which will be the problem. Nonetheless, at the end of the year, do you think that we're going to be at herd immunity here in Europe and there in the U.S.?
Yeah. So if there's a couple of caveats, i.e., enough people have been vaccinated and the variants are not a problem, and the long-term effectiveness of the vaccine remains high, there's no reason why we shouldn't be there.
Sam, thank you. Sam Fazeli there, Director of Research at Bloomberg Intelligence on vaccinations and variants. Now, coming up a little bit later today, we'll also be speaking to the BioNTech Chief Executive, Dr. Ugur Sahin. Look for that at 2:30 p.m. in New York, 7:30 p.m. in London, and this is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds on the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day. This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, the early edition. I'm Francine Lackman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get straight to the first word news, and the House takes up President Biden's $1.9 trillion stimulus bill today. Sometime tomorrow, the Democrat-led chamber is expected to approve the measure, while Treasury Secretary Janet Yellen is dismissing fears that the package is so big it will cause an inflation problem. She says if it turns out to be inflationary, there are tools to deal with that. At China's annual National People's Congress, the future of Hong Kong's electoral system is at stake. The NPC is preparing to pass a resolution this week to overhaul how the city holds elections, while critics say the move will tighten Beijing's hold over Hong Kong and leave no room for political opposition. And Gap is said to be considering a sale for its operations in China. Well, Bloomberg's learned that deliberations are at an early stage, and Gap could decide to keep the business. Revenue from Asia has been shrinking and accounts for about 5% of Gap's total. And finally, a big part of America's living expenses may get even bigger. Consumers expect rental prices will rise by a median 9% on the next year. Well, that's according to New York's Fed survey of consumer expectations. People under the age of 40 who were surveyed expect home purchase prices to rise at the fastest pace in 8 years, and that tends to lead to faster rent growth. That, Matt, goes back to the inflation debate we were having, but I know you took a day off also yesterday to watch the Royal interview, did you not?
Well, my wife was watching it, so I saw a little bit of it. I thought it was mildly interesting, but it seemed very Hollywood, Los Angeles. My sympathies lie with Her Majesty the Queen.
I still haven't seen it, Francine. I was going to go home and watch it after the show yesterday, and I just didn't have time. I did browse, though, the highlights on social media, so I will watch it fully. Today.
It is like a full-on Netflix film. If you go back to Rent, Matt, and this is a point that you were making in our morning call. So this is what happens. The anchor's coming and we kind of like talk and see what really captures our attention. And Matt was really intent on talking about inflation because rent will go up in America.
Well, because rent is such an important part of most people's budgets. Those people who don't own homes in the U.S., which I also think is a problem, they end up subsidizing people who do borrow money for homes because you get a mortgage interest reduction in America. Rent makes up a third, sometimes half, sometimes even more of their monthly spend. So if you see a 9% increase in rent, that's legit painful inflation.
Yeah, so we'll talk a little bit more about the pros and the cons of inflation. It does seem like it's a market participant versus economist kind of situation. Coming up, Bitcoin hitting a 2-week high. We talk about cryptocurrencies next.
We will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London. Matt Miller in Berlin, Kaylee Lines in New York. Losing my voice, Matt. It's all that, cheering at the television because of all the interviews we've seen.
Well, there's a lot going on today. We had this incredible rotation yesterday from growth into value, from the NASDAQ into the Dow, from tech into the old economy. And it's going to be interesting to see if that continues. Also, there's the great inflation debate, which I think is heating up and has a lot to do with, obviously, growth as well as yields. You've got the dollar question of the day on the MLive blog. Is this dollar rally going to basically last is the question. You can buy almost 109 yen for your dollar. So there's so much to talk about, Francine, that I can understand why you'd lose your voice. Get a little hoarse, you know?
Yeah, you lose the voice for those 10 seconds and then you kind of recatch your thoughts. Kaylee, I know, also wants to talk about the auctions, and we have some debt auctions in the U.S., and that could actually spark a little bit of volatility out there. Kaylee.
A lot of supply is coming onto the debt markets this week, Francine, starting with $58 billion in three-year notes today. Then we get more auctions on Wednesday and Thursday. But as for that rotation Matt was talking about yesterday, of course, we saw the widest divergence in the performance of the Dow and the NASDAQ since 1993, with the Dow hitting an intraday record and the NASDAQ sinking almost 3%. That's looking to flip in today's session, with big tech trying to stage a recovery. NASDAQ 100 futures up right now by 2 full percentage points, of course, being helped out by yields coming in on the 10-year in almost 7 basis points to below 2.25%, or on the 30-year, excuse me, once again. I would note that with yields coming in and a dollar that is weaker for the first day in 4, we are seeing gold rebounding off its worst lowest in 9 months, up about 1.3% when it comes to futures, looking to snap a 4-day losing streak. As for some stocks on the move, there could be some outsized moves come the U.S. Open in about 4 hours' time. Just take a look at Acadia Pharmaceutical, down 36%. This is all about the identified deficiencies in it. That is weighing on sentiment. Stitch Fix down 23% in the pre-market after a revenue miss. MicroStrategy, though, benefiting from a rebound in Bitcoin, Matt. It's up 10%. And Arc Innovation attempting to stage a comeback, up 4% in the pre-market after falling 30% from its peak, Matt.
I have to say, around midnight last night, I was trying to get my baby to go to sleep, but she was so pumped about this Bitcoin rally that I couldn't get her to doze off. I started talking to her about GDP growth projections, and that worked out here. But for me, this is incredibly exciting. Check out this chart. You've got the biggest divergence between GDP and 10-year yields that we've seen since, I believe, 1966. I remember that year because that was the last time England won a World Cup in soccer. You'd think the British were better at this game, but they're actually not. In any case, this shows you the yellow line is 10-year yields. The white line is actual GDP growth or contraction, and the blue line is the estimate from a Bloomberg survey. We're expecting nominal GDP to rise 7.6%, and yet 10-year yields are only at 1.5%. That divergence has to close somehow, and I think that's a really interesting chart.
Matt, the idea that Baby Miller actually wants to channel Cathie Wood and that you're reading forecasts for GDP to put her to sleep, I think is something that I will always love you for. Now let's bring the conversation back to Cathie Wood's funds. They're taking a big hit from the violent stock rotation. She's keeping her eye on the prize. She tells us she's sticking to her highest conviction names, including Tesla.
When we go through a route like this, first of all, the rotation now is happening very quickly. It started off slowly and is happening quickly. So I'm happy that the market is broadening out. This was the case in late 16 as well. Value took off and left growth behind. And whenever I see that happen, I say, okay, this bull market has broadened out. This is good news. What we do during these periods is concentrate our portfolios towards our highest conviction names. And so that's what we're doing. We had extended the number of names in the portfolio from the low to mid 30s at the bottom of the coronavirus. And now we're at roughly 55 for our flagship fund. And we are starting to sell the more liquid names and buy some of the more pure play names. So the more liquid names are either more mature, the Facebooks, the Apples, and so forth, or they are participating in innovation, but they're not pure plays. So Regeneron, Novartis, and so forth. So more liquid in order to have cash-like instruments to use at a time like now and move, again, concentrate towards our highest conviction names.
Well, to talk about tech and to talk about the rotation, we're joined by Eddie van der Vaart, a Bloomberg MLive strategist. Eddie, Matt demanded I speak to you about China. So let's talk about China. There was state intervention, and yet stocks, briefly went up and then went down. What does it tell us about the state of the market?
Yeah, I think that is a worrying sign. I think, the level of intervention that we saw in China is still some uncertainty there. But I think the fact that we didn't see a significant bounce back just shows you that there's a little bit uncertainty and a little bit about worry about bubbles more broadly. I do think that if the Nasdaq manages to pick up, that should spill over into China, and that should stabilize things potentially more than any state intervention could.
When I think about China, all I really think about is commodities. We've had the BCom index really rally, obviously. That's a sign of future growth, I guess, or expectations of future growth in China. But I wonder what you think this means for stocks, because we had Trevor Greedham on earlier, and he pointed out if you have experience, if you've been around for a while, Kathy Woods, for example, got her bachelor's at USC in 1981, so she's been in this industry for a long time. You can see that with these huge rallies in commodities, usually you get a pummeling of risk assets.
So we've had as you say, we've had a significant run up in commodities year to date and over the past year, over those sorts of timeframes. Over the last few sessions, though, we've seen the base metals come off significantly. We've seen nickel fall, 7% in one session, I think. We've seen tin come off. We've seen the smaller base metals, and it actually ties back to what Kathy Wood says. So we've seen copper doing particularly well during all of this. And I think that's where we're getting at. The rotation to value and the rotation to the high conviction plays, I think that's what's happening here. I think we're out of the phase of the buy everything rally. And I think where we are now is we're looking at those commodities that have a real good, fundamentals underlying, and the same for companies and the same for countries. And I think this is becoming a stock picker's market at this moment in time.
Well, to your point, Eddie, those sectors tied to commodities, the likes of energy, materials, and also value plays like financials are the new leadership in this market, but they don't pull as much weight. Still, the bulk of the market is tech. So if tech's going to lag, does that severely limit the potential returns?
Oh, it absolutely does. If you're going to buy the indexes, I think you're at risk here from a major, from a major pullback. We're talking about the Nasdaq and of course the S&P, not so much the Dow Jones. But I think, and that's why I think passive at this moment in time, I'd be worried about, because coming out of the sort of sea change that we've seen in the world economy and moving forward, there will be great opportunities, but it won't be across the board. And I think investors right now will want a good active manager on their side.
Tom Keen's been asking me for an entry point in Bitcoin for like 10 years now. It's not going to be this week either as it rises again to 53,000. What's behind the latest surge in optimism?
Yeah, I mean, look, one thing, I was a bit surprised, not so much by the surge in Bitcoin, but by the fact that after this significant run-up, we saw a period of stability just around the 50,000 level, which we are still in right now. And that's uncharacteristic for Bitcoin. But we do not see Bitcoin sitting still after a rally. We've never seen that before. Bitcoin pops and then it explodes. And, but what we don't see, we see it on drawdowns. So I think that was, maybe this is a sign of the market maturing, but I also think that maybe this is just a pause before the further upside.
Matt, I thought Tom Keen was like in and out of Bitcoin. He's like almost like a day trader. Isn't he on Reddit or something?
On Robinhood, on his Robinhood app, that's what he's doing all day. Well, you know what? If he is, I guess he could have made some money, and now it looks like people are forecasting. Evercore ISI is saying 75,000. That's a legit analyst house, right? Evercore ISI. That's a group of people that the street listens to. So very interesting as more and more people start gaining faith. I'm sure Tom is not among those people. Eddie, thanks so much for joining us. Eddie Vanderwalt from the MLive team. Coming up next, Nikolai Setzer, CEO of Continental, one of the world's largest auto parts maker. It may make the tires on your car. We'll talk to him about his outlook for 2021. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Hello everybody. If you're ready to place new order, I've got news for you. You can place an order to buy Japanese yen. The price I'm looking to buy 108,760. So I'm placing an order to buy Japanese yen at 108,760. Okay. So if you want to follow this trade, please do place an order. If you got the strategy, you will spot it. Why, and you know why we choose to buy at this level. So when it will get filled, we'll talk about it. Okay, I'll speak to you later, guys.
It's not just in the automotive industry. You see it in consumer electronics all over the place. Industry which was even increasing last year in demand, in particular in the second quarter with all the lockdowns which happened on home office supplies. That's where the automotive industry was in a standstill. And that's where, since then, the automotive industry is in a catch-up mode. That's why we have started this year with a subdued speed, which is mainly driven by semiconductor shortage, but as well by the further effects of the coronavirus pandemic. So we expect for this year still a market uptick of 9 to 12% during the course of the year. However, we expect as well that the shortage of semiconductors, as well as other raw materials, by the way, will still take and lag through the full year.
Are you, I mean, you talked earlier about costs, about 200 million euros for logistics. Is there a risk that those costs increase due to this current industry-wide problem?
I mean, the 200 million additional supply chain costs, which we announced today, are due to this raw material shortage, which we experience right now, and by the vast majority coming from semiconductor shortage. This is as good as we can anticipate and forecast right now. So it is a substantial impact. However, it's our best guess going through into the year. And as said before, we still expect this shortage to prevail during the course of the rest of the year.
Nikolai, good morning from London. If you're not supplying parts in time because of some of these chip shortages, do you think you'll get sued, and how much of a risk is that?
I mean, the full effort of us together with our suppliers and our customers is clearly to keep the supply chain running and making sure that the effects coming from coronavirus pandemic leading into the shortage will be mitigated as much as we can. So this is our clear effort together with our customers and suppliers 24/7. We are working as a team in order to keep it running, and this is our key first priority during the course of the year.
Obviously, your margin estimates for this year are well short of your midterm target. What concrete steps do you need to take in order to improve progress toward that goal?
I mean, we already mentioned at our Capital Markets Day last year that our targets, which we said, are midterm targets. Midterm targets means in a range of 3 to 5 years to be achieved. So 2021 is still a transition year. As said at the beginning, with...
Okay, guys, all done. We entered new trade at 108.760. This is where we ended. So let's see how long it will take us to get filled with profit and sell it. Hopefully it won't take long. Okay? Anyway, I'll speak to you later. It looks like it's already started to move on. I'll speak to you later, guys.
You see a pickup? Because it seemed to me at the beginning of this COVID pandemic, the best way to social distance would be to jump on my motorcycle and ride, and I've been doing that a lot.
I cannot more than agree, and congratulations, you have the best tires in our portfolio, and obviously you enjoy to ride them. But I agree further, we see that the trend to individual mobility has clearly increased during the pandemic. So I would assume personally that two-wheelers, I mean motorcycles as well as bicycles, this trend will continue and will further increase the market and further push for people to go out, and that's all what they want after being so much at home, to go out in the nature and with a motorcycle experience speed.
Nikolai, you know, Matt loves driving. I want to be in a car looking at inflation expectations or looking at forecasts. So I want autonomous driving. How much of that will be part of your revenue? And actually, do you need to spin off to take fully, you know, for create value for shareholders? You need to spin that off.
So autonomous driving, assisted autonomous driving is since long a strong part of our portfolio. And in the meantime, we have reached as well a strong position over there with more at a certain point of time of 2 billion business in this area. We announced today that we will further invest, as this is part of our portfolio of growth. Why growth? Because there we see lots of innovation, new technologies coming up. Markets positions of the future are still to be made up. And we still work hard in order to get a top position in this area. That's why we announced today that we will further invest 200 to 250 million euro into this area within this year in order to strengthen organically, but as well via partners, via startups, getting attractive and trying to get this technology position together as fast as we can.
Nikolai, thanks so much. Nikolai Setzer there. the new CEO at Continental, talking about the outlook. And Fran, it's interesting. I know you're all about, you want a driverless car. You probably want it to be electric. Meanwhile, I want to be at the wheel myself, naturally aspirated, 6 liters of a V8. We couldn't, we're great friends, but we couldn't be more opposite in terms of our car tastes.
Meanwhile, I literally can't remember the last time I was behind the wheel of a car. I live in New York City. What is a car?
I think a lot of viewers are like you, Kaylee. I think there are a lot of viewers working on Wall Street who are taking the 4, 5, and 6 to work, or maybe they were taking the 4, 5, and 6 to work, and now they don't want to get on a busy subway. So for the first time, they either bought a car or, like Francine, they just hired a chauffeur for, work from home. Isn't that over? Aren't we done with that? Coming up later today, Mike Wirth, Chevron chairman and CEO, talks about the stuff you put in the tank to drive most of the cars in the world. That's at 3:30 p.m. New York time, 8:30 in London. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance, early edition. I'm Francine Lackman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, Tom Keene, also New York, who co-anchor of Bloomberg Surveillance, now joins us. Tom, I know you're looking at the great rotation, but actually, are you still day trading, like in and out of Bitcoin?
No, I'm not out of Bitcoin. I've really given up on that. I've lost money twice at GameStop. I'm going to try to make it a hat trick today and see what I can do there. Let's go to the rotation. Ready, set, rotate. How charming is it to see rotation again? It's a real simple chart. The Dow leveling and actually doing pretty well. NASDAQ 100, you know the story, in yellow, flat on its back. And in the middle, sort of in between, the Standard & Poor's 500 and below at the Russell 2000. It's a very typical story, Francine. And, of course, in the short term, we all make a big deal about this. You wonder what it'll be. What's really important is last night I was trying to get over Meghan and Harry, Francine, and I was naturally aspirated, which of course is how Matt Miller usually is naturally aspirated.
17 million views.
17 million views.
17 million views.
Was naturally aspirated.
If you look at the numbers, yeah.
Yeah, Miller and I are on the same page. We're just like, no, we're not going to watch this.
But I think
No,
actually
and it caused
he's
a fight
watched
for
it
me
twice, haven't you, Matt?
with my wife. No, I didn't. Well, I refused to, and the wife was like insisting because she told me this is one of the most important things that's ever happened since some other royal interview. Yeah.
I recommend a little less vermouth and just go and be naturally aspirated. Here's what I got on the show today. We're thrilled to bring you Lawrence Boone. Francine knows her so well with the OECD. We'll look at the pandemic, the good news out of America with Amish Adalja, and Andrew Slyman will stop by on equities lifting.
Yeah, we're still waiting on that phoner with Meghan and Harry. That would be, they really want to come on and talk about inflation.
Talked to them, and can't get
we're sure
anywhere.
about their dollar call.
I was going to get Boy George on and see what he thinks.
Yeah, about what, inflation or dollar? Maybe pound. Tom Keene there, having his morning espresso.
Yeah,
now, let's have a look at what else we're watching. Matt.
I'm glad you mentioned the dollar, actually, and I'm sure that's what Archie's watching today on the MLive blog. If he reads MLive, you can see the dollar is question of the day. Will this rally continue, or is it a head fake? On the top of this chart, you see the dollar rally. On the bottom here, you see the 10-year yield. The question is, will that continue at 109 yen?
All right,
Kaylee,
Matt, well, I'm watching small business optimism, which actually just crossed a little bit early, coming in at 95.8 for the month of February. I wonder, though, Francine, if that's going to pick up, given it was a bit shy of expectations, if it will pick up next month with a $1.9 trillion stimulus package, Francine.
Kaylee, thank you so much. I'm not sure Baby Archie is looking at yield, but I think Baby George, or Prince George, actually is onto the MLive. Now, coming up in the next hour, the OECD chief economist, Lawrence Boone. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
We're in the beginning of 2021. What are your biggest worries?
The inequality of the current world environment. It's troubling, and I think it's actually getting worse, which is a big challenge.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
Yields are not so high that we're going to see a huge economic deterioration from here.
There's going to be a tremendous amount of fiscal stimulus that's going to justify higher yields. There is a very strong correlation between the last two rounds of stimulus checks and the inversion you're seeing. If the Fed starts talking about tapering their asset purchase program, I think that'll be negative for risk assets.
This is not a Fed that's going to hike upon a falling unemployment rate. And it's not a Fed that's going to hike when they start to sniff out inflation. They are going to wait.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The Nasdaq bouncing back from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your Nasdaq this morning up more than 2%. We have been whipsawed by a violent rotation, Tom Keene, over the last several weeks.
I sold everything yesterday, John. Looks like it was a mistake. John, it's an equity day today. It really correlates around the lift you mentioned, up 2.1% on the Nasdaq. What I would suggest, John, is we're just beginning to analyze what's going on with the stimulus. I love the work Steve Ratner did yesterday. I know he did it on Joe in the morning. This stimulus, John, is different than any we've seen, at least since World War II, 1947, in that period, and you see it in equities.
Well, Tom, it's massive, and you see it in the bond market as well, and you see it in the OECD forecast this morning, adding one single percentage point to global growth. That package alone.
We heard that yesterday, John, from Abby Joseph Cohen. Jan Hatzius, you know, is a cautious, a conservative guy. He's got a Western GDP lift out there, and Laurent Spoon really dovetailed with what we see from Goldman this morning.
And Lisa, that's the challenge for this bond market. That's the challenge for the supply that really ramps up over the next couple of days.
Yeah, you see that divide just growing between some of these GDP forecasts, the expectation for really robust growth paired with this very low yield environment. At the same time, I really want to draw your attention to the New York Times column by Paul Krugman. What? He was talking about, this is really important, he was talking about how just because there's going to be a boom from this stimulus doesn't mean, John, that there will be structural longer-term change out of this secular stagnation without additional spending. And this is the debate front and center in Washington.
Yeah, it's the short-term reopening story and the tug-of-war between that and the longer-term story and whether we return to trend growth. And trend growth is what, Tom? Something in and around 2%, back to normal again.
Yeah, this is really important. I'm going to go to Michael Ferroli at JP Morgan. We're going to get back to trend growth, John. Another phrase for it is potential GDP, and it's the when of it, John, and nobody out there has a clue when the when of it is. What happened yesterday, Lisa? Let me help us with this. That CDC headline came out about double vaccines and masks on. I was sitting in a restaurant that is barely getting by, even, with a it was a number 2 value meal yesterday, but I'm sitting in the restaurant and they were almost in tears over what CDC said yesterday. That's the good news driving this.
Well, the idea that they came out with such a timid kind of guidance here. And it goes to the stick and the carrot, John, that you have been talking about repeatedly, this idea of if you tell people it's all clear, they can go out and live their lives, people will actually get vaccinated and we could end this sooner. And if you don't, then people will feel like, what's the point? If everybody has to be vaccinated and everybody still has to social distance if they're outside, but if they're privately having dinner, maybe they can remove their masks and maybe give each other a hug.
I expected a little bit more than this. Am I allowed to say that? I expected a little bit more than this. Maybe I set the bar a little bit too high. Tom, the idea that if you're vaccinated, you can meet another person vaccinated indoors, that's what you get for being vaccinated?
Well, no, I think it's in stages, John. They're being ultra cautious. They don't want to make a mistake and have to retract it. They're dealing with the political battle of Texas, and even Mississippi's diving in, saying, the governor there, I believe, saying they want to be more cautious. But John, they're going incremental, and the best number is what you talk about every day, going from 900,000 out to 2.x million vaccines. Can we sustain it? Imagine where we'll be in 10 days as this discussion unfolds.
Hopefully closer to 2.5 mil. No one wants my view. We'll speak to Johns Hopkins a little bit later. Let's get to the price action this Tuesday morning. Good morning to you all. We are set up as follows on the S&P 500. Futures up 38, call it 39. We advance a little more than 1 full percentage point. In the bond market, yields in 6 basis points. I can't emphasize, stress this enough, that this has all been one trade. If you are a tech analyst on Tesla, one trade. If you are an EM FX analyst, one trade. An EM equity strategist, one trade, and that one trade has been the bond market, 152.63 on 10s. Dollar strength yesterday, dollar weakness today. Euro dollar back with a 119 handle, Lisa, up about 0.5%, and crude 65.71.
And when you talk about the dollar, it's something that I've been thinking a lot about, this idea that everyone piled into the weak dollar story, and now the strong dollar is totally upending the emerging markets trade. We'll be talking about that coming up. Meanwhile, today at 10 a.m., we've got the House possibly beginning to vote on what's going to happen with the retail trading, and so they're having a hearing about Robinhood. Excuse me, I jumped ahead of myself to the stimulus bill. They're going to be holding a hearing on Robinhood as some of these stimulus checks go into the hands of households and possibly fuel the trading boom. Then they're going to be discussing and possibly voting on the stimulus bill, the $1.9 trillion effort. Of course, the focus very much is what next do you have for me? And then at 1 p.m., John, I know you're going to be focused on this. The Treasury Department is beginning $120 billion of debt sales this week, including a $58 billion tranche of 3-year notes that comes today. Very interesting to see where the demand will come from. Will it be from the Federal Reserve, which has been one of the biggest buyers out there? Will it come from foreign investors that have been pulling back? Or will it come from the likes of PIMCO and BlackRock, who are starting to see possibly some signs of value after that incredible sell-off, giving way to yields that have been higher than we've seen in the past year?
Okay, what we're going to do now, folks, is we're going to stop the show. If you need any proof on this, the lovely Liz Goldenberg will explain to you that I can't stand auction chat. John, she and I got in a raging battle, 15, 20 years ago, because I don't give a damn about auctions. Guess what, John? Right now, I do, after that 7-year debacle the other day. And John, I believe you guys are the experts on this. We've got 3 coming up. John, why is this important?
38 billion of 10-year notes, 24 billion of 30-year bonds. And a lot of people have been talking about indigestion for quite a while now. Supply alone is not what drives the Treasury market. It's what you expect that supply to achieve. And I think last year was a great example of that. Supply absolutely boomed. Treasury yields still went lower. Why? Because the outlook for global growth was not as good this time around. That's changed this time. The supply matters because the supply is about to achieve something really quite big this year. And I think the OECD forecasts out this morning really underlined that this fiscal plan coming out of Washington, D.C., which will lead to more supply, is going to add a single percentage point of GDP growth to the global economy, Tom. And that's huge. So think about it. Where do you want to be? Do you want to be in treasuries in that kind of environment? No. You want to be somewhere else, which has been the story of the last several months.
Dumb question of the morning. It's always me. Right now, you know, Lisa, Lisa, who buys this stuff? Who's there to buy the auction?
Well, we have PIMCO coming out and saying that they actually starting to see value in some longer-term debt. We'll see about the 3-year, but there are a lot of investors. I mean, honestly, this is the key question, though. There are a lot of local investors that are going to be buying. There also are still foreign institutions, and there's a Federal Reserve, which has actually bought the bulk of treasuries issued in recent auctions.
Let's bring in Lawrence Boone, shall we? OECD chief economist, out with that forecast earlier this morning. Lawrence, fantastic to catch up with you. Can we just start right there? The degree to which this stimulus plan, this relief plan down in D.C. has shaped your forecast for the year ahead?
So we're revising our forecast upwards for 2 reasons. First, countries manage a little better the pandemic. Some of them are even vaccinating, so they can reopen their economy. And yes, the one thing which has changed compared with December is the 1.9 trillion US stimulus on top of the 900 billion in December. We think that will lift global GDP growth by about a full percentage point.
Laurence, good morning. Tom Keene in New York. Thank you so much for joining us. I'm fascinated, Laurence, of the diffusement of the U.S. prosperity over to China. Do you lift China up in step with America?
So, China had gone out of the pandemic a little earlier than the US, and it's still growing fast. It has benefited actually from the demand for medical product, for IT product. Now, there's one thing which hasn't changed in our projections. There were tension in trade, related to intellectual property rights, transfer of technology, support to state enterprises, and with a renewed multilateral world today, with a new head of WTO, we think this issue will start being addressed.
So there's a question about whether this really will benefit the rest of the world in the sort of reflationary mood that a lot of people were talking about. If you do get the U.S. driving growth and you get a stronger dollar, typically that is not necessarily positive for a lot of the developing world. How do you see that playing out and shifting the landscape for growth going forward?
So there's one thing we say in our projections is that the recovery is very uneven across the world. We're seeing divergences widening. That has to do, in particular, in some instances with what's happening on commodity prices, but in most cases, the driving factor of the driving force and engine of this outlook is really what's happening on the health front. So the divergences that we are seeing across countries today, they have to do with health management, with the pace of vaccination, and with how many sectors and how large a share of employees cannot work because of the health situation. I think we should really remain focused on this. That's our main message.
Then let's go to Europe then. The challenges of Europe right now, this, that, and the other thing. I know, Laurence, you're very much up to speed on this. What is your timeline for prosperity for Europe given the pandemic?
So in Europe, we have barely revised our outlook. We think that they will renew with pre-pandemic level by about mid-2022, which is roughly a year later than the US. And that, again, has to do with how vaccination and the health crisis is being managed. What we are telling Europe is, there's a lot on fiscal support which is being done. Economically, policies have been fantastic. Policymakers have done the job. But on vaccination, they need to go much faster. If we're at war with the virus, really, Europe needs to get on a war footing now.
Laurence Boone, always great to catch up with you. Thanks for being with us this morning. OECD Chief Economist. Let's just re-emphasize this. The revision to forecasts for US growth this year from the OECD this morning, from 3.2% back in its November forecast, Tom, to 6.5%.
Yeah, and what's so important about that is, an institution out of Paris is being as conservative as they possibly can.
Big change in the last several months. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bramvitz, I'm Jonathan Ferro. Futures up 43. We advance a little more than 1%. The why is, of course, in the bond market. We're down almost 7 basis points to 152. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A highly contagious variant of the coronavirus is circulating in Florida. That's raising concern. The resurgence of the virus is possible in the state and beyond. The per capita rate of coronavirus patients in Florida hospitals is about 25% above the national average. At China's annual National People's Congress, the future of Hong Kong's electoral system is at stake. The NPC is preparing to pass a resolution this week to overhaul how the city holds elections. Critics say the move will tighten Beijing's hold over Hong Kong and leave no room for political opposition. Shares of Coinbase changed hands at a roughly $90 billion value last week. That might be the final chance for investors to trade its private stock before the cryptocurrency exchange goes public later this month. The offering will be Nasdaq's first major direct listing, an alternative to the traditional IPO. And the Pentagon is preparing what would essentially be a flat budget for the fiscal 2022. The military had expected an increase under President Trump, former President Trump. A budget of roughly $708 billion under President Biden would amount to a decrease of about 2% in real terms once inflation is factored in. The OECD says that a U.S. recovery turbocharged by the new stimulus package will help power a faster than expected global upswing. And the report says Europe could be left behind. The Paris-based organization said it now expects global output to rise above pre-pandemic levels by the middle of this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Last weekend, as you know, the House of Representatives passed our American Rescue Plan. It is a plan that will provide immediate relief to America's cities, towns, and villages, and directly to the American people. This past weekend, the Senate advanced this landmark legislation, and very soon, the President of the United States, Joe Biden, will sign the American Rescue Plan into law.
Kamala Harris, the U.S. Vice President, from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's the Tuesday morning price action. It looks like this on the S&P 500, up almost 40. We advance a full 1 percentage point. In the bond market, yields are lower, down by 6 basis points. That's driving everything. That is the catalyst for the price action cross-asset worldwide. 152.81 on a US 10-year. In the FX market, euro stronger, dollar weaker against pretty much everything today. Euro dollar 119.06. The lira firmer by 2%. The rand stronger by 1.5%. The peso up by more than 1%. It is yesterday, Tom Keene, upside down.
It's yesterday upside down, but I'd go further than that, John. There's just a different feeling, again, off the CDC headline yesterday, and of course what OECD codifies it. We've been hearing from our guests here on our simulcast. Right now, Jack Fitzpatrick with us out of Washington on the update. Jack, I'm going to try to coalesce forward to what I believe is a scheduled speech by the President of the United States Thursday. He will speak of COVID. No doubt it will be good news about the better trends we will see. But there are the other issues, the stimulus front and center, and maybe beneath the fold of too many internet sites is the migrants and the children on the border. Let's line those ducks up. Let me start with the children on the border. How big of an emergent issue is this right now for the president?
It's a very significant one. It's one he's starting to be pressured on more by Republicans in Washington. There's a lot of confusion about how exactly the president is going to address immigration legislation, and the fact that there is essentially an emergency on the border complicates that further. It could be just a quick bill that they need to do, a supplemental spending bill to increase resources, or it could make things a little bit murkier with some of his broader immigration wants for a bigger bill down the road.
I know John wants to go to stimulus and the dynamics of the last couple days. Let's do a pandemic update. This is a victory lap for the president on the pandemic, isn't it?
Yes, this is a huge one. $1,400 checks shows people, Democrats actually can follow through on the things they ran on. The child tax credit is something they are really celebrating. They lost on the minimum wage, but that was the one significant portion that was a disappointment for them. Overall, it's sort of a B plus or A minus, I think, for a lot of Democrats.
Jack, can we get the roadmap, just the short-term one from you, next couple of days when the vote is, etc.?
It's probably going to be tomorrow. There was a paperwork issue going from the Senate back to the House. It could be late today, but probably tomorrow. The vote looks like it's pretty good, but they do have narrow margins, so it's not over till it's over. But the House is expected to pass it tomorrow, and then Biden can sign it pretty soon after that.
How quickly do you expect us to go on from this, kick on and start the infrastructure negotiations?
They're already starting to talk about it, but Biden has withheld. So there's a lot of conversation about how to address infrastructure. Biden could move to that pretty quickly. That does get murky, though, with how they want to address it. They are not entirely clear if they can go the reconciliation partisan route like they did with this one, or if it has to be bipartisan. So they have to put some thought into how to approach that procedurally. But in terms of their focus, that's the next big thing that they'll move quickly onto.
And Jack, the process really matters when it comes to taxes, when it comes to whether or not the nation has to balance the budget. Can you talk a little bit about the different sides on that, how likely it is that we're going to see proposals for higher taxes later this year?
Yeah, we know the Biden administration, a lot of congressional Democrats want to increase the corporate tax rate to 28%, increase taxes on the highest earners and larger corporations. The question is, do they fold it into an infrastructure package as a pay for? Are there climate-related taxes, something like a carbon tax or otherwise, that could also be a pay for on that? And again, the question of whether it has to be bipartisan or partisan, which is a procedural and a political question, because Joe Manchin could force them into bipartisanship even if they don't need to, according to the parliamentarian, is a pretty big X factor. So it's not clear how they're going to approach that in its own bill for taxes or in a bill that pays for everything else. That's one of the biggest things they have to decide relatively soon.
Jack, before we let you go, I want to ask about the pandemic and the idea of the CDC guidance that came out yesterday saying that people who get vaccinated, they can meet up with other people who haven't gotten vaccinated as long as they're low risk, they're in their own homes, and have signed all sorts of waivers. I mean, there basically wasn't that much more freedom for getting vaccinated. How much pushback is the CDC getting in the administration for not taking a more liberal approach with what you can do once you get jabbed?
We haven't heard much about pushback against the CDC just yet. In fact, the administration really has taken a very conservative approach to saying, well, we'll have the number of vaccines we need by mid or late May, but it could be a long time before life is back to normal. Keep in mind, when you get vaccinated, it's most effective something like a month after that. So the administration has really been careful about making promises about life going back to normal wholeheartedly for a while after there are enough vaccines.
Jack, always good to see you, sir. Great to catch up. Jack Fitzpatrick there of Bloomberg Government. Tom, for about, 6 months, we've been talking about the prospect of vaccine passports to travel. It was Qantas that started the conversation down in Australia. I imagine behind the scenes, and I've seen some reporting recently on this, that there's a huge lobbying effort from the airline industry not to go down that road.
You know, I was thinking about the other day in the West Wing of the house, you know, where, you know, off the master bedroom, John, we've got that shelf where you got all your garbage on it, and I've got all the kids' passports and that on it. I'm looking at the passports, it you know, is before I'm coming in trying to pick out the bow tie. And John, why can't we do that with the vaccine? What's the difference?
On what, the passports?
Yeah, the passport.
Sorry, I'm just so thrown by this shelf that I think everybody else has.
I would agree. I'm standing there looking at my passports going, John, why can't we do that now on the vaccine?
Look, I think the ultimate fear that sort of dominates almost everything still, it's pervasive, is just the idea of creating a two-tier society when not enough people have been vaccinated.
Get vaccinated. Why should there be two tiers? You don't have a choice. We're all going to die if you don't.
We're at 10% right now, and I think once you get closer to 20%, to 25 to 30, then things start to change.
Hold on a second. There also is a fear that once there is ample supply, if people have been trying to get vaccinated and have had obstacles to actually getting an appointment, they're going to not try as hard once there is enough vaccine. That's one theory out there.
Well, Lisa, they'll try as hard as they can if they can't get on an airplane. It's just that simple.
Okay, fair. And then the other issue is people are concerned that they don't have a sense of how contagious somebody might be if they get infected once they get vaccinated. So that could, you know, accelerate the spread that already is accelerating in different places.
Okay, what you're essentially saying, is it a social issue or a